Hi everyone, I hope you are doing well. I hope your preparations are going really great. So today we will start. Today my plan is to cover almost all of your big chapters, the chapters that scare us as a student, the chapters that are really important from exam perspective and that cover really good weightage in exam. So my plan is to cover today, I will be covering IFRS 15, as you all can already see on the screen, IFRS 15, IFRS 16, financial instruments, and interpretation. So yesterday we had completed consolidation. We took we did consolidation. We took NCA, also non-current assets. We had also taken some small chapters, IS 37, 20, and like this. So today my plan is to cover this. So if you cover whatever we have covered, with this you'll be able to cover around 80 to 85% of the syllabus, and the remaining small chapters we can manage together. The remaining chapters, you all can manage. So these are some important chapters that we find it, when you're revising on your own, you'll find it a little difficult to do it on your own. So I've picked up these chapters. So let's start without wasting a single minute. We will start with IFRS 15. IFRS 15, revenue from contracts with customer. So ma'am, firstly understand on what all contracts this standard is applicable. This standard is applicable only on your contracts with your customer. So if you have contracts with anybody else other than your customer, this standard will not be applicable. So first we understand here, this chapter will tell us, this standard will talk about revenue. This standard will talk about revenue. Now we all know during our regular batch, we took almost 1 week to just understand this chapter. So again, a very good, very comprehensive and a very beautiful standard that you'll learn. So let's start without wasting our time. Let's start IFRS 15, revenue from contracts with customers. Now, my dear friends, please understand, revenue is recognized. Here, what is a core principle? Firstly, revenue is recognized when or as the control of the goods or services is transferred to the customer at the amount that the entity expects to receive. So here we are focusing more on transfer of control, not just risks and rewards. Here we are focusing more on transfer of control. So you all know, earlier days, revenue recognition was very simple. You sold goods, recognize revenue. If you sold on cash, debit cash, credit revenue. You sold on credit, debit debtors, credit revenue, that's it. Now, revenue recognition is more detailed and more comprehensive and a lot more interesting, I would say. So, my dear friends, you all already know that revenue recognition we follow 5-step model to recognize revenue. So, what is this is very, very important. Be it FR, be it SPR, this 5-step model is very, very important, not just from your exam perspective, but also very, very important from your real life perspective as well. So let's start with our first step of your 5-step model of revenue recognition. First step is identify the contract. You will have to identify the contract. So, ma'am, when do we say that the contract exists? A contract exists only and only if all of the 5 conditions are met. What are the 5 conditions? The contract should be approved by both the parties. The contract should be approved by both the parties. Rights of each parties have been identified. Payment terms have been identified. There is a commercial substance and the collection is probable. When all of these conditions are met, then and only then we say that there is a contract. First step has been fulfilled. Then and only then we say, and only after that we can recognize our revenue. If not met, you cannot recognize revenue. For example, a company delivers goods, but the customer is financially unstable and the collection is doubtful. No revenue until the probability improves. So you will not recognize the revenue until all of these conditions are met. So ma'am, what kind of questions? Now let's talk from exam perspective. What kind of questions we can expect? You can expect MCQs on this if your concepts are clear. So they may test you whether we can recognize revenue or not, and they will give you any of the situation, any case study wherein any of the situation is not met. So you should be aware of what are the conditions. What are those 5 conditions in your first step of your 5-step of revenue recognition model? If these 5 conditions are met cumulatively, all of these conditions should be met. Either of this condition is not met, you are not allowed to recognize revenue. Your first step itself is not fulfilled. Now, second one, identify performance obligation. So another one more thing that I would like to add in between here. Even if you're watching this for the first time, if you just watch this video, this recorded video, if you're not confident on IFRS 15, if you've never studied this chapter before, even if you just watch this video, I've tried to put everything in these notes. You just watch, you refer these notes and you just watch this video, you will be done with this chapter. I'm telling you, if on the scale of 10 you'll secure 7.58 if you just watch this video. The notes are very detailed and we've covered I took almost 1 week to cover this chapter. Now I've tried to keep it as short as possible so that within maybe 40 minutes we can complete this whole chapter, big chapter, and very good weightage. It carries a really good weightage. You can expect really good marks, be it a big case study or a small MCQ. You can expect good questions on this. If your concept is clear, this chapter is very easy. I'm telling you, very scoring chapter. Now, so second step is identify performance obligation. What is a performance obligation? A performance obligation is a distinct good or service. So if I'm teaching you, I'm a teacher, what is my performance obligation? What am I obliged to do? I'm obliged to teach you all. So here my performance obligation is to teach you all. I'm providing to provide you all with a service. So you will have to identify separate performance obligation, distinct performance obligation. So start using these words when you're solving a case study or anything. Distinct performance obligation. Now, when do we say that a good or service is distinct? Distinct means separate, different. When these 2 conditions are met. First, customer can benefit from it separately and it is separately identifiable in the contract. See, for example, let's say I promised you that I'll teach you and I'll provide you with my notes. Now here you will have to identify, I've made 2 promises to you, so 2 performance obligation. Here you will have to identify whether these promises are different or single. So for example, if I tell you, you can watch my notes, you can watch my videos and you can use my notes as well. So in this case, even without my notes, you just watch my videos, you'll be benefited. Yes, customer can benefit from it separately. You can refer your own notes without referring my notes. You can definitely benefit from it. Yes. Secondly, if you just refer my notes and you don't watch my videos, that is also possible. You can do it. You can watch whatever lectures you had taken and you refer my notes, whatever you like. As a student, we do this. We often do this. So here, if you can benefit from it separately and it is separately identifiable in the contract. And it is separately identifiable in the contract. In this case, we say there are 2 different performance obligations. One is to provide you all with notes and the second one is to provide you all with lectures. So for example, sale of a laptop, sale of a warranty, 2 different POs. Construction of a customized building, 1 PO, not distinct. So usually you'll get a question like this. The question will tell you that the contract is to build a customized building and there are so many performance obligation, layering, and architect work and all of that in construction and everything. So here you will have to say that since there is a significant integration, there's a one word here. Instead you can write also there is a significant integration. Ma'am, what is a significant integration? The contract is every other activity, every other promise is integrated, is mixed to give it each other. So in that case, we say that there is 1 single PO. If these 2 conditions are met, or there's an end in between, not or. So when these 2 conditions are met, you say that the performance obligation is distinct. Start using the word distinct in your answers. Okay. So the third step is determine transaction price. Very, very important. Now here this is one of the detailed step. Firstly, understand what is a transaction price. Transaction price is any amount that entity expects to receive. So for example, I'm teaching you all and my fees is, let's say, 10,000 rupees. So what is the transaction fees here, transaction price here? 10,000 rupees. What I expect to receive from you all. So it can be anything. See, transaction price is very detailed. Now, first one is, it can be a fixed consideration. For example, easy, stated in the price. 10,000 rupees is what I expect to receive from you all. Simple as that. Variable consideration. Now, it can also include variable consideration. For example, discounts, refunds, any performance bonus, any penalties. For example, let's say if you all get a rank, I'll get additional 10,000 from you all. So this is nothing but a variable consideration. It is dependent on you all performing, on you all getting rank. So anything like performance bonus, any such thing that is dependent on happening or a non-happening of something, this is a variable consideration. I'm not sure yet. So there are two methods of measuring your variable consideration. First one is expected value method. The other one is most likely method. Ma'am, the question is, when do we use these two methods? First one is when there are multiple probabilities, when there are multiple outcomes. For example, either, I'll give you an example. When there's a range of outcome possible. Ma'am, range of outcome means what? For example, let's say there's a contract wherein if 1 to 20 students get rank, I'll get 10,000 rupees. If 21 to 40 students get rank, I'll get 20,000 rupees. Okay, if 40 to, let's say 41 to 60 students get a rank, I'll get, let's say, 30,000 rupees. So there's a range possible, yes or no? So here I will have to multiply each of this range with a probability. Let's say this is, the probability of this is 0.5. Probability of this is 0.25, probability of this is 0.25. So I'll multiply this with, I'll multiply the transaction price with the probability, and whatever amount comes here will be my variable consideration. This is nothing but your expected value method. You expect what amount you can receive. So how do you expect? You apply probability to it. Now the second one is most likely method. Now when do we use most likely method? So you all can write it here whenever you all are revising. You all can write it here when multiple outcomes are possible. Okay. Now, second one is when you apply most likely method when only two outcomes are possible, either this or that. For example, let's say if 20 students get a rank, if all the students get a rank, I'll get 50,000 rupees. If none of you all get rank, if not all students get rank, I'll get nothing. So in that case, it's a most likely. Either all of you all will get rank or you all won't get rank. So in this case, there are only two outcomes possible. So when two outcomes are possible, you apply most likely method. What is most likely to happen? So most likely to happen is you all getting ranked. So in this case, I'll take whatever is my variable consideration. I'll consider it in my transaction price. So most likely when only two outcomes are possible. Now, ma'am, we have learned everything. Now, how do we recognize variable consideration? The standard says you recognize variable consideration only when it is highly probable, not even probable. Probable means 50% chances. Highly probable. It should be highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. So you recognize variable consideration only and only when it is highly probable that significant reversal of revenue will not occur when the probability is resolved. So that was all about our variable consideration. Next we go to significant financing component. Now, ma'am, what is a significant financing component? When there's a difference, there's a time gap. If payment timing gives financial benefit, adjust the present value. If there's a time gap, let's say I'm teaching you all today, you all will pay me 2 years later. So there's a time gap between performance obligation and the payment. We say that there is a significant financing component. For example, customer pays after 2 years. So you will have to discount revenue. For example, I'll get 1 lakh from you all 2 years later. Now this is a future value. I'm done teaching you all today. My performance obligation is satisfied. So I will have to recognize revenue today on present value. So you will recognize a revenue on today, present value. Now here there are two possibilities. My dear friends, please understand when I'm talking about significant financing component, there are two possibilities. And what are the two possibilities? For example, customer performance obligation is satisfied, PO satisfied, performance obligation satisfied, payment pending. Second one, payment done, performance obligation satisfied. Possible, very much possible. Yes, ma'am, very much possible. So if your performance obligation is satisfied, can I say as per IFRS 15, I can book revenue? Just 1 minute, allow me 1 minute. When your performance obligation is satisfied, can I say I can book revenue? The answer is yes, I can book revenue. So what is the journal entry you will pass here? You will credit revenue. Ma'am, we credit revenue? Yes. And you will debit what? You will debit your receivables. Receivables. Now that you have learned IFRS 9 also, now we have covered each and every standard, you all know this is nothing but your receivables is nothing but your financial assets. Now you will recognize revenue at what? Present value, my dear friends. You will recognize revenue at present value. Why, ma'am, present value? Because the payment is pending. Now payment will be made in a future date. So whatever is a value, this is your future value. So you will discount the revenue, you will pull it, you will bring it to the present value, and in that value you will recognize revenue. And what after this? What after this? You will have interest income on it. For example, now this is at your revenue. Your revenue is at present value. Your receivable is also at present value. Okay, let me take a number and explain this to you all. Let's say you all will pay me 2 years later 1 lakh rupees. You all will pay me 1 lakh rupees 2 years later. The present value of this is, let's say, just giving you some random number, 82,931. This is the present value. So, ma'am, how will we recognize revenue? What is the journal entry that you will pass here? You will debit receivable. You will credit revenue. Not at 1 lakh, my dear friends, not at 1 lakh. You will recognize revenue at 82,931. 82,931. Now, ma'am, what's next? Now, this revenue is gone to P&L. That's done. Done. We're done with this. Now, this is your nothing but your financial asset. You will incur, you will recognize interest income. Yes. So, ma'am, how do you recognize interest income? Every year, there's a journal entry that you will pass. Debit, receivable, credit your interest income. 8293. 8293 at 10%. Let's say that the discount rate is 10%. I forgot to give you the rate. 93. So whatever is that rate, I mean, in my example, I've taken 10%. Whatever is the rate given to you all in your exam, you will pass that journal entry. So 2 years later, your receivable will automatically become, you are unwinding it using the same rate you discounted it. So what will happen? 2 years later, your receivable will become exactly 1 lakh. So 2 years later, what you will do when your receivable will appear at 1 lakh, 2 years later, you will debit bank 1 lakh because now the customer will pay me and I will credit receivables 1 lakh. So as simple as that. So we say when your performance obligation is satisfied, your job is done, but the customer is yet to pay you, we recognize your financial asset here. We recognize financial asset, that is receivable. Okay. Now, ma'am, what's next? What if customer paid me today, but performance obligation is not yet satisfied? You paid me today. You said take 82,931. You said take 82,931 today. I'll take your lectures 2 years later. Okay. So in that case, can I recognize revenue? No. The answer is no, because my performance obligation is not satisfied. The very core, the basic principle of IFRS 15 is your performance obligation. If your performance obligation is satisfied, recognize revenue. So I can't recognize revenue, but I've received money. So I will debit what? I will debit bank. Yes, I will debit bank 82,931. I will credit here financial liability or payable. I will credit here financial liability. I'll credit financial liability 82,931. Now, ma'am, what next? You all know financial liability, you all know the accounting treatment, your financial asset, financial liability treatment. Now, this every year you will charge interest on it, interest expense. So, what you will do every year? You will debit, not bank, you will debit interest expense and you will credit financial liability. Let's say the rate is 10% only, 8293, 8293. Now going forward, 2 years later, your financial liability will appear at what? Your financial liability will appear at 1 lakh. 2 years later, financial liability 1 lakh. will appear at 1 lakh because again the discounting, they will give you the present value only in the question. So 1 lakh. Now what next, ma'am? What you'll do now, you will debit financial liability 1 lakh. The money has been received and you will credit revenue. So I've given you all the possible areas. If there's a significant financing component, how do we account for this? So very simple. Pay attention. What will happen? Usually you will be tested on this part. Usually this is the most favorite part, but we should be okay with every aspect. We should cover each and every single thing, each and everything. So please pay attention. When do we say that there's a significant financing component? When there is a time gap. Time gap in what? Time gap in payment and satisfaction of performance obligation. Okay, so this is very important to pay attention here. It will either be your financial asset or a financial liability. Financial asset, you will recognize revenue at present value only. You will recognize revenue at present value. Now we talk about non-cash consideration. And what is the meaning of non-cash consideration, my dear friends? Here consideration is given in the form of non-cash. For example, shares. I'm teaching you, let's say I'm teaching you FR, SBR, and you're paying me, instead of paying me in money, you're paying me your company shares. Let's say maybe Srivarshan shares. Okay, Srivarshan Limited shares. So here the consideration is a non-cash consideration. So I will have to measure the non-cash consideration at fair value. Now the question is, ma'am, how do you fair value of what? So first preference is always given to what is received. If I can measure fair value of what is received. Here I'm talking from the supplier, the service provider, the goods provider's perspective. If I can measure the fair value of what is received, then I will recognize revenue. That is my transaction price. If I cannot measure, for example, let's say I'm teaching you FR, and instead of paying me in cash, you said, ma'am, every single little, let's say for 1 month our course is going on. So for every for 1 month, your breakfast, your lunch, and your dinner is at my place. So here I cannot measure the fair value of the consideration what I'm receiving. So in that case, what will happen? In that case, if you cannot measure, if I can't measure the fair value of what is received, then transaction price is fair value of what is given. So here fair value of my lectures will be my transaction price. So transaction price is fair value of what is given. Given means the teacher, the goods are supplied, the service is supplied. So are we all okay with this part? So usually they will give you a scenario wherein you can measure the fair value of what you have received. But if at all the question you don't know, you cannot predict, if at all anything else is asked, you should be okay. You should know the accounting treatment of each and everything. Okay. So now the next one is consideration payable to a customer. Consideration payable to a customer means what, ma'am? This means I am paying you something. For example, let's say I'm a service provider and you are my customer. So you are by default, you will pay me money. But if at all I am paying you something, let's say I'm paying you 5,000 rupees. So the standard says whatever you are paying to your customer is in return of something. If it is in return of something, in return you are teaching me something else. For example, I'm teaching you FR and you're teaching me Tamil in return. And the 5,000 that I'm paying you is for teaching me Tamil. Then you will recognize this as a separate transaction. 5,000 what I'm paying you, if it is in return of any distinct goods or services, then it is a separate transaction. You will recognize this as a separate transaction. And what if I'm paying you something to compensate you for something? So here in the question they will give you for compensating or for something like that. So in that case, if it is for compensating you for something, then transaction price will be reduced by that value. And what do you mean by this? For example, let's say I'm teaching you FR. Okay. Now, my class, the cost of my class is, let's say, 10,000 rupees. Now, for using this classes, for accessing these classes, you will have to download some software. Let's say the software will cost you 2,000 rupees. So I said, okay, don't worry. Whatever cost you all incur, I will refund you. I'll pay it to you. So in that case, 2,000 what I'm paying you, 2,000 is what I'll pay you back. So in this case, my transaction price will be 8,000 rupees. Why, ma'am? Why 8,000 rupees? Why are you reducing it? Because this 2,000 what I'm paying you, consideration payable to customer, is not in return of any distinct goods or services. So in that case, you will treat it as a reduction from revenue. You will reduce the revenue. Your transaction price will be 8,000 rupees. Okay. So be very careful what question they are asking you. So what are the hints, ma'am, we should look for? They will give you that you're compensating the service provider, the goods provider is compensating the customer. So if it is for some compensation or something like that, the trigger point is here. You will have to see this is your consideration payable to the customer. So what is the rule? What is rule? Reduce revenue. General rule, reduce revenue. Unless the payment is for distinct goods or services. So if you're teaching me Tamil in behalf what in return of what I'm paying you, in that case, this is nothing but a separate transaction. So for example, I sold goods for 100 and I gave a rebate. So here my revenue is 90. So memory line, what you need to remember is, from exam perspective, paying to customer, reduce revenue. Unless they give you a real service in return, unless you're giving me something in return, then I will not reduce revenue. So with this, we have completed the third step also of our this 5-step revenue recognition model. The fourth step is allocate transaction price. Fourth step is allocate transaction price. Now, allocation of transaction price. We have identified contract, my dear friends. See, we have identified contract. Now we have also identified our performance obligation. We have identified transaction price also. We have determined transaction price also. Now whatever transaction price you determined in step number 3, I'm giving you a memory trick how to remember it. Whatever transaction price you determined in step number 3, you will allocate in the performance obligation that you identified in step number 2. Let me repeat this again. Whatever transaction price in step 4, whatever transaction price you determined in step number 3, you will allocate it in step number 2. Whatever performance obligation you identified in step number 2, you will allocate it in that ratio. Okay. So ma'am, how do we allocate it? What word that you need to remember is, you will allocate based on the standalone selling prices. You will allocate transaction price on the basis of standalone selling prices. We also call it as SSP. Okay, this is a short form that I'll use. You all please don't use this SSP short form in your exams. So if SSP is not directly available, you will have to estimate SSP using what? Any adjusted market assessment, expected cost plus margin, and any residual method. Usually they will give you the SSP. Usually you will not have to determine the SSP. They will give you the SSP. Now, for example, let's say the total contract price is 1 lakh. What is my laptop? Now, what are my 2 performance obligation here? I am selling laptop plus I'm selling warranty also. So here I have identified 2 performance obligations: sale of laptop and warranty. So ma'am, what is my what are the standalone selling prices of this? 80,000 and 20,000. This is the SSP standalone selling prices. So this contract price 1 lakh will be allocated in these 2 in the ratio of their SSP. So usually now the allocation will be in the price will be same, SSP and the transaction price will be same. Usually it may be like they may give you a situation wherein your SSP is 85,000 and this is 25,000. Okay, so in that case you will have to allocate this 1 lakh. For laptop, how much it will be? 85,000 divided by 85 plus 25. For warranty, how much it will be? 1 lakh into 25k divided by 85k plus 25k. So this is how you will allocate your transaction price. Okay, ma'am, we're good with this also. Now we go to the next step, that is your recognition of revenue. Step 5, recognize revenue. Now we have come to the last step of our revenue recognition model, that is recognition of revenue. So when do we recognize revenue, guys? When do we recognize? Revenue is recognized, as I told you all, revenue is recognized when the control is transferred, when the control transfers. So there can be 2 ways your revenue recognition. You can recognize revenue in 2 ways. Now, what are the 2 ways? First one is when your performance obligation is satisfied over time. Mark my words, when the performance obligation is satisfied over time. And the performance obligation is satisfied at a point in time. Satisfied over time at a point in time. So if your performance obligation is satisfied over time, you will spread the revenue over time. If your performance obligation is satisfied at a point in time, you will recognize revenue at a point in time. So ma'am, how do we do it? So for over time, if any one of the condition is met, if any one of the condition is met, my dear friends, anyone, you will conclude that the performance obligation is satisfied over time. In that case, you will recognize revenue over time. So ma'am, what are the conditions? First condition is customer simultaneously receives and consumes the benefit. For example, I'm teaching you. Let's say the duration of the course is 2 months. So here you're simultaneously receiving the benefit and you're consuming it. So in that case, your performance obligation, we can conclude the performance obligation satisfied over time. I'm not just teaching you, I can't teach you FR in just 1 day. I can't teach you SPR in just 1 day. So here your performance obligation is satisfied over time. Entity creates assets that customer controls. I'm creating an asset. For example, you have a land. I'm constructing a house on your land. I'm building a house on your land. So I am creating an asset that you all control. So in that case also we say your performance obligation is satisfied over time. An asset that has no alternative use plus right to payment. So this is important. This is important. This is where a lot of you all will make a mistake. If there is no alternative use, it means what? Your asset is of specialized nature. Specialized nature. And what do you mean by specialized nature? I'm constructing a submarine for you. Nobody else can use it. Only you can use it. A specialized submarine. Okay. So it is a specialized nature. If you don't purchase, I will not be able to sell it to anybody else. I will not be able to sell it. So in that case, if you're specialized, if your asset is of specialized nature, plus you have a right of what? Right to demand payment. Right to demand payment for work done till date. For work done till date. So in that case, we say your performance obligation is satisfied over time. So ma'am, does that mean if I am constructing a specialized nature and if I don't have a right to demand payment for work done till date, so in that case, can I say that the performance obligation is satisfied at a point in time? Yes. In that case, you will say, you will have to conclude that your performance obligation is satisfied at a point in time. So if you don't have, now what is the logic behind this? See, logically think, if I have a right to demand payment, it means what? Let's say 20% submarine is done, I can ask you for the payment. 30% submarine is done, I can ask you for the payment. If I can't do that, it means what? Whenever the whole submarine, 100% submarine is ready, then and only then you will make me. I don't have a right to demand payment for the work done till date. So it means when the 100% submarine is complete, then and only then my performance obligation will be satisfied. So in that case, we say performance obligation is satisfied at a point in time. So it does not matter what work you have done, but when it is done, then and only then you will get the payment. So in that case, performance obligation is satisfied at a point in time. So if it is a specialized asset, you should have a right to demand payment for work done till date. If you don't have a right to demand work done till date, then your performance obligation is satisfied at a point in time. If you have a right, then performance obligation satisfied over time. So do not make a mistake. First two are simple. I know you all will get this right. I know, I'm very sure about this. Third one, you'll make a mistake. So don't make a mistake. Third one, be very careful. Specialized asset, alternative use, with no alternative use, plus right to demand payment for work done till date. So right to demand payment, here I'll add one more thing, right to demand payment for work done till date. Okay, are you all ready? Okay with this part? Now, so for example, your cleaning services, any construction contract, any teaching, whatever I'm teaching you all, so it is nothing but your work done, performance obligation satisfied over a point of time. Okay. Now, the second one is performance obligation satisfied at the point in time. At a point in time means what? Here you will have to check. When do we conclude that the performance obligation is satisfied at a point in time? When you've transferred, there are indicator of transfer of control. So what are the indicators? When you've transferred legal title, when you've transferred the physical possession, when you've transferred risks and reward, customer has accepted and you have a right to demand the payment. So in that case, we say that you have transferred the control has been transferred from supplier to the customer. In that case, you will conclude that your control has been transferred, performance obligation has been satisfied, and you can recognize revenue. For example, I'm selling you a bottle. So the day when I sell you the bottle, from my possession to your possession, you have made me the payment, I have a right to demand the payment. So in that case, we conclude that the performance obligation is satisfied at a point in time. Okay. So again, let's come to this part. When the performance obligation is satisfied over a period of time. Ma'am, how do we identify over a period of time if any of these conditions? See, the case study will not be, you're appearing for ACCA exams. So this not the case. Questions will not be clearly evident. Here you will have to identify whether the performance obligation is satisfied over a period of time or at a point in time. So when you conclude reading the case study, when you conclude any of these conditions are met, you conclude that okay, the performance obligation is satisfied over time. So now here you will have to measure the progress because the performance obligation is satisfied over time. So here you will have to measure okay, how much revenue should be recognized. So there are two methods of measuring the revenue. What are the two methods? Here you will have to measure progress. You can measure progress using output method or input method. Now ma'am, what is the meaning of output method? Based on results achieved, units delivered. So they will tell you the certified, this and this person has certified based on this. Output method, basically on the results achieved. Input method, usually based on the cost incurred. So for example, here they will give you, let's say your total cost for the, let's say 96,000 is your total cost. Your total revenue is, contract price is 2 lakh. Your total contract price is 2 lakh. 96,000 is your total cost. So let's say up till today, you have completed 48,000. You have incurred, not completed, you have incurred 48,000 of the cost, 48,000 worth rupees cost. So how much work has been done? 48,000 divided by 96,000. You will find out the percentage of work done till date. Can I say 50%? So in that case, you will recognize revenue of 50%. So ma'am, it means what? Transaction price multiplied by 50%. That is nothing but your revenue will be recognized at 1 lakh. You will recognize revenue of 1 lakh. Okay. So this is the one of the method. This is your input method. You will check on the basis of work done till, cost incurred till date. And output method, you based on results achieved. So they'll give you surveyor has, any XYZ architect has given a report. So as per the report, this much work has been done. So here they will give you the percentage done. If there is an input method, you will have to calculate, you will have to identify the work done till date. In this case, the work done till date will be given to you all. In this case, you will have to calculate. Here you will have to, they will give you cost and all. Here you will have to calculate the percentage of work done. So you can definitely expect questions on this. Good MCQs you all can expect. If you're solving your exam kit, you all have seen that there are good amount of MCQs on this. So please pay attention, focus on this part. Good and test-worthy area. Now contract modification. Now what do you mean by contract modification? If a contract is modified, there are two situations, guys. There are two situations. Either it can be a separate contract or it is not a separate contract. Now when do we say that it is a separate contract? When do we say that it is a separate contract? It adds distinct goods or services. For example, I'm teaching you all FR and SBR. I say I'll teach you all audit also. So in that case, here whatever I am giving you all, it is a distinct, and the price reflect the standalone prices. Now what is the meaning of price reflect standalone price? For example, let's say today if you want to purchase audit lectures, you will have to pay 20,000 rupees. If you want to purchase audit lectures, you will have to pay 20,000, and I'm charging 20,000 only. So it reflects whatever I'm charging from you all, it reflects the standalone price of that goods and service. So I will have to account separately. It means what? If our SBR recorded separately and auditing recorded accounted separately. When do we say that it is not a separate contract? When we conclude either of this does not meet. Either of these does not meet. Either the goods or services are not distinct, or the price does not reflect the standalone prices. For example, I'm just teaching you maybe let's say some extra case studies. I promised you all to teach you all, let's say, just FR study material. Now I'm teaching you all exam kit also. Here goods and services are not distinct. And let's say I'm charging, I'm teaching you all audit. Second example, I'm teaching you all audit. But what I'm charging, the SSP of audit is 20,000, but I'm charging only 9,000. So in this case, we will conclude that the contract is not separate. The contract is not separate, and I will. What is the accounting treatment possible here? You will treat it as a termination of an old contract, and you will recognize a new contract. So you will have to treat either, there are two options: terminate the old contract or recognize a new contract, or you will recognize this as a part of the existing contract. So it depends on remaining services being distinct or not. What I'm providing you all, if it is distinct, if it is separable, then in that case, we conclude that the contract is not separate. Now let's talk about contract cost. Now, what are contract cost? These are incremental. There are two types of contract cost that you can capitalize, ma'am. Here you can capitalize your contract cost. So what are the contract costs that you can capitalize? First one is incremental cost of obtaining a contract. For example, commission. So if you will capitalize only if it is recoverable. Second one is cost to fulfill a contract. So for capitalize if it is directly related, if it will generate future economic benefit and recoverable. So in that case, otherwise you will expense it and otherwise you will capitalize it. So if these conditions are met, you will capitalize cost to fulfill a contract and incremental cost of obtaining contract. So these two costs can be capitalized if they are recoverable, and if not, if these conditions are not met, you will charge it to P&L as an expense. Now next we talk about contract assets and a contract liability. Now what is the meaning of contract asset and liability? For example, revenue recognized. I've tried to give a situation here. Revenue recognized is more than the billing. So in that case, it is your contract asset. For example, I am allowed to recognize revenue of 1 lakh, but I've billed you only for 90,000. So in that case, the extra 10,000 of revenue that I've recognized is your extra 10,000 of revenue is my contract asset. I've not billed you. I cannot recognize you as a debtor. So I will recognize you as what? Nothing but as a contract asset. Now if billing is more than revenue recognized, in that case it is your contract liability. For example, you billed me for 1 lakh, but I have recognized revenue of, I can recognize revenue as per IFRS 15, I can recognize revenue of only 90,000. So in this case, the extra 10,000 is nothing but your contract liability. Ma'am, can you give us a journal entry of these? Journal entries help us understand even better. Yes, definitely. So we take first situation, okay? We will take first situation. In this case, when the revenue recognized is more than billing. So we will take the situation where your revenue recognized is of 1 lakh and I have billed you for, you've billed me for 90,000. So how will you recognize this? Credit revenue, very simple, credit revenue, 1 lakh. I've billed you for 90,000. So can I recognize you as an debtor? Yes, I've billed you. I have a right to receive 90,000 from you. So debit, debtors. Debit, contract asset. 10,000. So are we okay with this part? Next one is, ma'am, what if your billing is more than revenue recognized? For example, you billed me for 1 lakh and I can recognize revenue as per IFRS 15 of only 90,000. So can I say I will credit revenue of how much? 90,000. I will credit contract liability, not financial liability, contract liability of 10,000, and I will debit debtors of 1 lakh. Because you have billed me, I have a right to recover 1 lakh from you. Okay, so in this case, we conclude. So this is a simple formula you all can use in your exam to identify whether it is your contract asset or a contract liability. If your revenue is more than billing, contract asset. If billing is more than revenue, contract liability. So be very careful. Now here the confusion comes as, ma'am, when do we say that it is our financial liability or a contract liability? What is the difference? Now it is a very thin line of difference, guys. A lot of you all might get confused, ma'am. When do we recognize a financial asset? When do we recognize a contract asset? When do we recognize contract liability? When do we recognize financial liability? See, financing component will come into picture only and only if there is a time gap. If there is a time gap, usually here in such situation, time gap will not be there. Within 1 month, within 2-3 months, you will anyways settle this. So if there is a time gap between your performance obligation and your revenue performance obligation and your payment, so in that case only, you will your financing component, your financial liability, financial asset will come into picture. If there is no time gap, you will simply recognize contract asset or a contract liability. So when you're analyzing any case study in any of your question, see, take care of dates. They will give you dates. So be very careful when you're taking the dates. Ensure what is the time gap between the performance obligation and the billing and your payment. If the time gap is less than 1 year, it is a contract asset or a contract liability. If the time gap is more than 1 year, then your financing component will come into picture. Then you will have to discount it and recognize at a present value and all that. Okay. The next one is warranty. So there are two types of warranties, guys: assurance type warranty and service type warranty. Now assurance type warranty is not a separate performance obligation. Just 1 minute, guys, allow me 1 minute. Now your assurance type warranty is not your separate performance obligation. You will recognize a provision under IAS 37. Service type warranty means what? It is a separate performance obligation. Revenue is deferred and recognized over time. Can you give us an example? See, performance assurance warranty is what? For example, you went to purchase a LED light. They give you an assurance type warranty. Nothing will happen to this LED light for, let's say, 6 months. So this is nothing but an assurance warranty. Nothing. I'm giving you an assurance. But let's say you went to purchase an iPhone. Now the seller is telling you, you pay 10,000 extra. We will anything happens to your phone for next 2 years, we have got you covered. So in this case, you're paying something extra, right? You're paying something for getting that warranty. So that is nothing but your service type warranty. So how do we identify whether it is an assurance warranty or a service type warranty? A simple formula to identify it. In this case, you are not charging. You're not charging anything extra from the customer. But in this case, you are charging something extra. See, I will be talking from the service provider or goods provider's perspective, because here we are talking about revenue, right? Revenue, who will recognize? The one who is providing services and the one who is providing goods. So that is why I'll write you and you and me. So what I'm POV, whose POV we are talking from? The one who is providing goods and services. So POV, Gen Z language POV. So this is talking from supplier, POV of supplier of goods or services. So here in this case, supplier is providing what? Is supplier, you are charging something extra for warranty. So these are the indicators that it is your service type warranty. You will identify, you will treat it as a separate performance obligation, and you will recognize revenue as you will treat it as a you will treat it as a separate performance obligation, and you will recognize this as over a period of time. I hope you are okay with this. Now we talk about some small situations that will be given in the question. Principal versus agent. If entity controls the good. Now, what are the indicators that you're a principal? When you control the goods before transfer, you're a principal. If you are arranging for the goods and services, you are an agent. So principal will recognize revenue at gross, and agent will recognize net commission only. For example, Zomato, what are they doing? They're arranging, they're providing us with what we say, a platform wherein you can order goods, where you can order food from restaurants. So here I am paying 1,000 rupees to Zomato. Let's say I ordered a biryani and I paid 1,000 to Zomato. Now here Zomato is an agent. So Zomato is just providing me a platform. This whole revenue, this 1,000 is not revenue of Zomato, not a revenue of Zomato. Zomato will pay, let's say, out of this 900, Zomato will pay to whom? Restaurant. Let's say whatever, from whichever restaurant I ordered. So 900 will be paid to restaurant, and 1,000 is the commission charged by Zomato for providing this platform. So Zomato will recognize revenue of 1,000 only, and restaurant will recognize revenue of 900. So please ensure that Zomato cannot recognize revenue of a gross amount. They will give you a situation here wherein they will tell you the agent has recognized this revenue, 1,000 revenue. So if it is an agent, if it is just providing me a platform, if it is arranging only goods, it does not control the goods before transfer. It does not have inventory risk. It does not have discretion of price. So in that case, you cannot recognize. You will recognize revenue only on net basis, the commission that you're receiving. So such situation, just identify whether it is an agent or principal versus agent versus principal relationship, and recognize revenue accordingly. For example, travel website earning commission. Just one. Make My Trip. All of these, they're just arranging, they're just providing you with a platform. Now, the next one is repurchase agreement. Again, one of the most favorite parts of this chapter, one of the most interesting discussions of this chapter. And again, as a student, I feel, as a teacher and as a student, I feel people are scared of this part because it takes time to understand. So I'm just trying to simplify it. So within whatever time you are spending with me, just next 10-20 minutes, we should be able to understand this. So if you this is actually very easy, but people are scared of this. With experience, I've understood that usually students don't like this part, but I will ensure that you'll enjoy this as much as I enjoy teaching. So firstly, understand what is a repurchase agreement, my dear friends. Here, a repurchase agreement exists when an entity sells an asset but also has an arrangement to repurchase the asset later. For example, I'll slow down a bit here because this is the area where students find it difficult to understand. For example, I sold this bottle to you. Let's say your name is Shivani. I sold this bottle to Shivani for 1 lakh rupees, and as per the terms of contract, there is an agreement. As per the agreement, I will repurchase it in future date. Let's say 2 years later. So it is a repurchase agreement. I have sold this to you, but I will repurchase it. I'll buy it back. So this is a repurchase agreement. Now, please understand, your repurchase agreements can be of 3 types. Now, ma'am, what are the 3 types of repurchase agreement? Forward. First one is a forward contract. Call option, put option. Ma'am, are you talking about what we learned in FM and AFM? No. I'm not talking about call, forward and put that you learned in your AFM. No, it's not those. We are not talking about that. Keep those forward, call and put aside. We are learning, this is a different forward call and option, forward call and put option. So that we are not talking about that. So don't get confused. Don't mix those two knowledge. Yeah. Keep that area for your FM and AFM only. Now when I'm talking about forward contract. Now what is a forward contract? Here. As per the agreement, entity must repurchase. You will have to repurchase. So in that case, you don't have here you will have to repurchase. So in substance, you have not actually sold the asset, right? So no revenue is recognized. Ma'am, no revenue is recognized. Why? You sold the asset, right? But you will buy it back. So the control has not been transferred. I sold this asset. I sold this bottle to you, ma'am, Shivani, ma'am, and I will repurchase it. As per the contract, I don't have any other option. I will have to repurchase it, let's say 2 years later. So in this case, in substance, I have not really sold the asset to you. So IFRS 15 will not be applicable. So ma'am, no IFRS 15? Yes, no IFRS 15. So we don't have to do anything? No. Because now here you will have to check whether it is a lease or a financing arrangement. And lease means what? Which standard? IFRS. You all know IFRS 16, IFRS 9. So, ma'am, when do we conclude it is a lease? When your repurchase price is less than the original price. For example, let's say the original price, I sold this asset to you for 100 rupees, and the repurchase price is 90. So in this case, repurchase price is less than your original selling price. We treat it as a lease. Ma'am, lease. So how do you account for this as a lease? Sale and lease back. We'll come to this when we learn. This is not a part of your FR curriculum. Not a part of your FR syllabus. This you will learn in SBR. So this will be treated as a sale and lease back transaction that you all will learn in your SBR. So what you need to remember is, if your repurchase price is less than your original selling price, in that case you will recognize this as a lease. Now what if your repurchase price is 110 and your selling price is 1000? So this is nothing but a equals to or more. If it is equals to or more than the original selling price, it is a financing arrangement. It is treated as a financial liability. It means that you've given this extra that you've paid me. This 100 rupees that you've paid me is nothing but a loan that you've given to me, and this extra that I'm paying you, extra 10, is nothing but interest that I'm paying you. So here we will treat it as your financing arrangement. This will go to your IFRS 9 financial assets and financial liabilities. So for example, company sells machinery for 1 lakh, agrees to repay after 1 year for 1,10,000. So this is basically a loan. You will debit cash, you will credit financial liability, and interest expense is recognized over time. What is the interest expense here? In this case, interest expenses of 10,000. You cannot recognize revenue because in substance you have not sold the asset. Now, second one is call option. I hope this is okay. I hope you are okay with this. This I've tried to simplify as easy as possible. Call option, forward option, just pay attention that customer, entity must, not customer, entity the entity will have to repurchase it. So in that case, you will have to compare what? Two things. You will have to compare repurchase price with your original selling price. If it is less than, then it is a lease, IFRS 16. Ma'am, how do we account for this lease? Leases you will learn in SPR. Do not bother about it right now. Be stress free right now about sale and leaseback. They will not test you definitely on that. Second one is if your repurchase price is more than your original selling price, in that case it is your financing arrangement, IFRS 9 will be applicable. So here you see financial liability, IFRS 9. Now, call option, when the entity has a right, not obligation. It is my wish. In the first one, I had an obligation. Forward, I had an obligation that I will have to repurchase it. I didn't have any other option. But here, I have a right, not obligation. That if I want to, I will repurchase it. So in this case, to repurchase the asset. So here you will have to identify. Again, just like if your repurchase price is less than your original selling price, it is nothing but a lease. So customer is basically paying for a temporary use, no revenue, recognize lease accounting. If your repurchase price is greater than or equal to your original selling price, just like the previous one, financing arrangement, customer is just providing a finance, again, no revenue. So can I conclude when I'm talking about forward and when I'm talking about call? Forward, where the entity has an obligation to repurchase. Call, where the entity has a right to repurchase. In that case, there is no revenue recognized. So you will not recognize revenue. You will just check two things. You will compare repurchase price with your original selling price. If your repurchase price is less than your original selling price, you will recognize what? Lease. IFRS 16 will be applicable. If your repurchase price is greater than or equal to your original selling price, in that case, you will recognize what? You will recognize financial liability. It is a financing arrangement. IFRS 9 will be applicable. Okay. Now let's come to the last part. Last option of your repurchase agreement, that is the put option. Put option means here the customer has a right that require obligation to repurchase the asset. It means what? The customer can put back the asset. What do you mean by customer can put back the asset? For example, I sold you this asset. As per the terms of the contract, you have a right. Now you have a right that if you wish to, you can put it back to me. You can put it back to me. So it means the customer has a right and I have an obligation. I have an obligation when the customer puts it back to me. So here the right is with you. Now ma'am, can we just simplify it? Can you please just tell me how do we identify? Forward, I have an obligation. Call, I have a right. Put, you have a right now. Okay. So here I have in put option, I have obligation and you have right. In forward, neither of us have any right. I just have an obligation. So this is a little bit more complex. This is where students find it a little bit more difficult. So you will have to compare what? Repurchase price with the estimated selling price. So for example, I sold this asset to you. Okay. I'll tell you, I sold this asset. I'll give you some details here. Our original selling price is 100. Okay. I agree to repurchase. I agree. The repurchase price is, let's say, 110. Now here you will have to compare. In call and forward, we just compare these two options. Now here you will have to compare it with something else also. Here you will have to compare repurchase price with estimated selling price. So you will have to check. Okay, I'm an entity. I will have to check. Okay, 2 years later, Shivani ma'am can put it back to me. So 2 years later, what is going to be the estimated selling price, estimated market price of this bottle? So I feel, okay, the estimated market price of this bottle is going to be 120. Oh, that's good. You have a right to sell it back to me for 110. In market, if you sell, you will get 120. So obviously you will sell it in the market. So in this case, can I say repurchase price is less than your estimated selling price? In this case, can I say your repurchase price is less than your estimated selling price? So you will not have economic incentive to put it back to me. You would rather sell it in the market. So in that case, you will not exercise the put option. You will not exercise put option. So I will not recognize revenue. In this case, no revenue. Why no revenue? Because the customer does not have significant economic incentive to put it back. Now, let's say another situation, your estimated selling price, it's let's say 90. You have a right to sell me something for 110 that can be sold in market for 90. So obviously, you will put it back to me. So you will put it back to me. Sorry. Here, sorry, let me rephrase it. When your repurchase price is less than your estimated selling price, it means you will not exercise the put option. It means the control has been transferred. Yes, revenue. Sorry, a little area. So yes, revenue, because here you will sell it in the market, you will not put it back. So it means the control has been transferred. I can recognize revenue. Ma'am, how do you recognize the revenue? You still have a right. So here I will recognize revenue with sale with right to return. Sale with right to return. Okay. In the second situation, wherein you have a right to put it back to me for 110, but your estimated selling price is only 90 rupees. Estimated selling price is only 90 rupees. So in that case, you will obviously exercise your put option. You will obviously put it back. So in that case, when your repurchase price is more than estimated selling price. So in that case, no revenue. Why no revenue, ma'am? Because you will, in substance, the control has not been transferred. In substance, no control has been transferred. So we conclude what? The control has not been transferred. So we conclude that customer will put it back and I will recognize a revenue. I will not recognize a revenue. So if your repurchase price is less than the estimated selling price, it is less than. So is customer going to estimate? So no, you will normal sale with the right to return and no economic incentive to exercise it. So you will just compare two things, estimated selling price and your sale with right to return. Okay. So the next one is we talk about bill and hold arrangement. Now, ma'am, what is the meaning of bill and hold arrangement? What is the meaning of bill and hold arrangement? Bill and hold arrangement, revenue is recognized only and only if valid business reason, goods identified separately, ready to transfer, and entity cannot use it elsewhere. For example, you came to me and you wanted to buy this bottle. Now, here, if you told me, I billed you for 1000 rupees and you said, I will not buy it, I've billed it, everything has been done, you please hold it for 2 years. Not 2 years, let's say for 1 year. So here, if I'm holding your asset for 1 year, so here you will have to identify, see whether there's a valid business reason. Maybe you don't have enough space. Maybe you don't have enough space. Second one is, can the goods identified separately? Can I identify it separately if I've kept it aside only for you, reserved it only for you, ready for transfer? An entity cannot use the goods elsewhere. It means what? You have a valid reason for the keeping it on hold, keeping it aside. You have the goods can be identified separately. I know that this is a bottle number 20 is for you and it is ready for transfer. If tomorrow, maybe you have asked me to hold it for 2 years. If you come tomorrow, can I transfer it right away to you? Yes. And it cannot be used elsewhere. I cannot transfer it to anybody else. So in that case, you call it as bill and hold arrangement. You will recognize revenue only and only if only if there's all these conditions are met. There's a valid business reason. You cannot transfer it to someone else, and these goods are separately identified, and your goods are ready for transfer. The next one is consignment arrangement. What is the meaning of consignment arrangement? Revenue is recognized only and only when customer sells it to the end customer or the control is transferred, not when goods are delivered to the dealer. So, ma'am, what do you mean by this? See, my dear friends, understand. One thing you need to understand here is, let's say I am a dealer and you are a manufacturer. I'm a dealer of cars and you're a manufacturer of cars. You sold me 100 cars to sell it to the end customer. So let's say today I'll prepare a timeline here. Let's say today, what is our date today? 25th of February. You gave me 10 cars to be sold to the end customer. Okay. And let's say our year end is 31st March. So by 31st of March, I was only able to sell, let's say, 5 cars. So when you transferred it, I'm talking from your perspective now, from your POV. When you transfer 10 cars to me, you will not book revenue for this. You will not recognize revenue for this. Why? Because the revenue will be recognized when I have actually sold. So you will, when I've actually sold these cars to the end customer and the control has been transferred. For example, the control has been transferred to me. For example, as per the terms of the contract, the control has been transferred to me. I'll have to pay you. So if any of this condition is met, firstly, when the dealer has sold it to the end customer, then and only then you can recognize revenue. Just because you have given it to the dealer to sell it to the another party, to sell it to the end customer, you cannot recognize revenue, guys. You will recognize revenue only and only when either of this condition is met. Either the dealer sells it to the end customer, or the control has been transferred. Okay, so with this we complete our revenue recognition part. With this we complete our IFRS 15, and now I want to start with before taking up questions for my panelists, to complete all those chapter IFRS 16, IFRS 9 and your interpretation part. We'll just revise it. We'll revise each and every chapter, then we'll go to the questions. Then the questions will go very smoothly. Now we'll start with leases. Now, IFRS 16 leases. Objective of IFRS 16 to ensure most leases are recognized on the balance sheet date. Now, IFRS 16, very simple, one of the easiest chapter as far as FR syllabus is concerned. This is one of the easiest chapter you'll ever study. Now, lessee, almost all leases are capitalized. Lesser accounting is largely unchanged. So see, lesser accounting is not there in your FR syllabus, so we will not cover lesser accounting. It's not there in your FR. You will learn lesser accounting in SBR. Now, the first step is you will have to identify, does a contract contain lease? If the contract is a lease, if there's an identified asset, the customer has a right to control or use for a fixed period in exchange of a consideration. Now, ma'am, what do you mean by this identified asset? For example, I've given this asset on lease to you. So, identified asset, I can identify which asset. Second, the customer has right to control use. You have a right to control how to use this asset. You can decide whether you want to use it for water bottle, or for using it for any other purpose. You get a right to decide how you want to use it for a period of time, for a specified period of time, maybe let's say 1 year, 2 year, 3 year, whatever. In exchange for a consideration, here you will pay me some lease rentals. So when do we say that there is an identified asset? It is if it is explicitly mentioned, building A, bottle 20, or implicitly specified. You know that I have only one bottle, so it is implicitly specified that there is the lease is for this bottle only. Or supplier must not have SSR. SSR, ma'am, what do you mean by SSR? It is substantive substitution right. When the supplier does not have SSR, substantive substitution right, it means what? The supplier will not substitute. Ma'am, can you give an example for this? Yes. See, understand, let's say I have 10 bottles. Okay, I've given this on lease to you. Now, I have a right to substitute it if it is beneficial to me. Let's say I've given you bottle number 20. But if I feel like right now I need bottle 20 for another customer, I'll give it to you. I'll give bottle number 10 to you. So if I have a right to substitute the asset as per my wishes, in that case, you all don't control. There's no identified asset. You don't control the asset. So in that case, it is not an identified asset. It is not a lease. I have no idea, Samya. I'm just going normal. Is the pace too high? Do you want me to slow down a bit? Please, I'm not sure if you can watch it at 2x while it is on live. Just check this video, no, ma'am. So you will have to identify. When do we say that the asset has been identified? When the building it is explicitly mentioned, or it is implicitly specified, or when we say that the supplier does not have SSR. SSR means what? Substantive substitution right. I don't have a right to substitute. Usually this is in the case of cars and all. When the cars are given on rental, if the supplier has a substantive substitution right, means supplier can substitute the asset if he wish to. In that case, we say that there is no identified asset. If there is no identified asset, no lease. Now, control test. Ma'am, what do you mean by control test? See, when I was talking about lease, we say that the customer controls, has a right to control the use. So when you say that, when you conclude that the customer controls, when customer must obtain all of the economic benefit and direct how and for what purpose the asset is used. If both are satisfied, we call it as lease. Now, what do you mean by this? For example, if I'm giving this bottle to you on a lease, so in that case, what will happen? You have a right, you will, whatever are the economic benefits from this bottle, you will get, and you will direct, as I told you, you will direct how and for what purpose you will use this asset. For example, you want to use it for juice or maybe whatever, just stupid example, but you decide to use how you want to use. So in that case, we say the customer controls the asset. So lessee accounting is, if you identify the asset, you know the lessee has a right, there's an identified asset and lessee has a right to control the asset. So in that case, we conclude there is a lease. So there is a lease, so there will be two parties. In lease, there are two parties, lessor and lessee. So first understand who is a lessee. We have identified lease now. Now we have to identify who is a lessor and who is a lessee. So, this is my asset. Let's say this is a building. I am a legal owner of this and I have given this on lease to you. So the legal owner is a lessor and the person who is using it for time being is a lessee. So here for FR syllabus, you will learn lessee accounting. It is more focused on lessee accounting. So on the date of commencement, now very interesting and very simple. One of the simplest chapters you will study in your FR syllabus, lessee accounting. At the commencement date, on the date when you enter into the lease, lessee will recognize two things. Ma'am, what lessee will recognize? Lessee will recognize a ROU asset, right of use asset, and a lease liability. A ROU asset and a lease liability. So initial measurement. Now, ma'am, let us understand what is ROU asset and what is a lease liability. Initial measurement, lease liability. It is measured at present value of your lease payment. So, ma'am, like it's like it's sir, it is ITS Sami, by the way. I guess I have to change the name. Yeah, a bit slow down because it's too speech and we read a page and want to finish. Okay, I'll slow down a bit. Sami, if I'm correct me if I'm wrong. I hope I'm pronouncing your name correctly. Yes, Sami, I'll slow down a bit. I'll try to just cover it as in less time. I have to cover 2-3 chapters and big chapters actually. So I'll try to slow down a bit. I hope that works. Okay. So yeah, lease liability. How do you recognize lease liability? It is nothing but the present value of your future lease payments. Mind you, future lease payments. So for example, as per the agreement, for next 4 years, I will pay 10,000. Let's say I'm a lessee and you're a lessor. So what are the lease rentals? I'll pay 10,000 to you all every year. These are lease rentals. So how do you measure your lease liability? You will have to identify a rate. Now I'll come to that rate part. What is a rate? I'll come to that part a little later. Okay, discount. It is given here only. So you will have to discount it using either interest rate implicit in the lease or incremental borrowing rate. Now usually we take this one. If it is identifiable, if you can identify interest rate implicit in the lease, you take this, or incremental borrowing rate. Now, ma'am, how do we identify it? How do we do it? In the question, they will give you. As far as your question is concerned, they will give you rate implicit to the lease or lessor's incremental borrowing rate. They will give you. You need not worry about that. You need not identify it. They will give you in the question. So just look for these two words. What are the two words? Rate implicit in the lease and incremental borrowing rate. I'll stick to the exam focus. So let's say the rate implicit to the lease they have given in the question is 10%. So what you will do? You will Okay, you will pull it using this rate. So what is a, how do you do it? Present value. You'll have to find out PV factor. Ma'am, what is a PV factor? You all are masters at it, I hope, at this point of time. Raised to 1 like this. You will find out a PV factor and you will find out the present value. The present value of your all, the total, subtotal of all your present value, the total of all your present value is nothing but your lease liability. So what do we need to focus here is step 1 is identify lease liability. Ma'am, how do you identify lease liability? See, what are your future payments? Future, what are you paying? Whatever are your future payments, you will pull it using the present value, and the total of your present value is nothing but your lease liability. The total of your present value is nothing but a lease liability. So step 1 is your lease liability measured at a present value of your future lease payment. Now, what is included in lease payment? First one is fixed payment, any fixed payment. Let's say 10,000 rupees. In my example, I've taken 10,000 rupees. Second, variable payments rate to linked to interest or a rate. Maybe they'll tell you that every year your payment will increase by 2%, or maybe will increase by CPI. They'll give you a CPI and everything they will give you. And any residual value guarantee. Let's say residual value guarantee is nothing but, let's say 10, whenever at the end of the lease term, I'll pay you 20,000 rupees also. Along with lease rentals, I'll pay 20,000 also. That is your as a residual value guarantee. Exercise price if purchase option. If I'm reasonably certain that I'll purchase it, if there's a purchase option in the agreement, in the lease, there's a purchase agreement wherein I will purchase the asset. So if lessee is reasonably certain to exercise that option, you will include purchase price also while calculating your lease liability, and termination penalty if reasonably certain. I know that 2 years later I'll terminate the lease, and to terminate I'll have to pay you 20,000 extra. So this 20,000 will also be included when only if lessee is reasonably certain to exercise any of these options. What are the options? Purchase option or termination. Exclude purely variable payment. Exclude based on usage or sales. So any purely variable payments, if they are given based on the usage or based on the sales, these will be excluded. Usually they will not test you on this. Usually they will not test you on this part. The payment, they will tell you this only. This part only. They'll test you on this part only. They'll give you fixed payment or maybe interest or a payment linked to rate or a CPI. Or they will give you RVG, that is RVG is nothing but your residual value guarantee, purchase option or a termination penalty. So you will identify all the lease payment, you will identify the rate, and you will pull it to the present value, and the present value is nothing but your lease liability. Now the next one is ROU asset, right of use asset. Now what is ROU asset? How do you recognize it? Initial measurement, lease liability plus any indirect initial direct cost plus any restoration cost plus any prepayment, that is less any lease incentives received. So let's say my lease liability is nothing but whatever is the future present value of your future lease payment is, let's say, coming to 10 lakhs. I will increase my ROU asset is not just 10 lakhs. I will, if there are any initial direct cost, so I will add an initial direct cost 10,000. Let's say if there are any prepayment means on or before lease commencement, on or before the commencement of lease, if you've paid anything. So that is also included in your ROU asset. Let's say I paid one installment in advance. I paid 1 lakh rupees in advance. So this is a prepayment, advance payment. This also will be included less any lease incentive. If there are any lease incentive, you will reduce your ROU asset by that. So this will give you your ROU asset. So ma'am, what do we need to remember from exam perspective? Lease liability plus any direct cost, any restoration cost, any dismantling or a restoration cost, just like IS 16, any prepayment, and less any lease incentives received. Now, subsequent measurement, very simple. Subsequent measurement, very simple. Lease liability, you will increase your lease by interest and you will decrease it by the lease payment using EIR method. Ma'am, can you please give us a format? So you will prepare a lease amortization schedule. Lease liability amortization schedule. Okay, so how do you do it? There are here opening liability, opening, interest, payment, lease payment, and closing liability. This is a table that you will have to prepare. Now let's say the lease term is 5 years, 1, 2, 3, 4, 5. Opening, whatever is your opening liability, whatever is a present value for future lease payment, you will write it here. You will increase your lease payment by interest. Let's say the interest is, I'll take some random numbers here. Let's say my opening liability comes to 1 lakh. I will increase it by interest. Let's say the rate implicit to the lease is 10%. So I will increase it by 10,000. That's a payment. Payment is 7,000. So whatever is a closing balance, ma'am, how do you get the closing balance? Opening liability plus interest minus prepayment will give you your closing liability. Now this will become your opening liability in the next year. Likewise, you'll keep on doing it for all the 5 years. So this is nothing but your lease amortization schedule. Lease liability amortization schedule. Every year you will have to do it. Now, one of the most tested areas of your lease liability is classification, current and a non-current classification. Now, understand here, a lot of you all get confused. As a teacher of experience, a lot of you all have a doubt on how do you classify lease liability as a current or a non-current. So any principal that is to be repaid within next 12 months, within next 12 months is your current liability. Anything that goes beyond 12 months is your non-current portion. So here there will be two situations. See, calculation of your current, rather bifurcation of a current liability and a non-current liability will differ depending on whether your lease payments are in arrears or whether your lease payments are in advance. Ma'am, what is the meaning of this? Lease payment in arrears means what? They will tell you that the payments are due at the end of the year, or payments are due in the arrears. Payments are made in arrears. So in that case, your payments are made at the end of the year. Payments are made at the end of the year. So in that case, next payment will include what? Interest as well as principal. Your next payment will include your interest as well as principal. So you will, when I'm talking about current portion, you will take next payment minus next year's interest. Next payment minus next year's interest, because only principal is current. So ma'am, what is the meaning of this? If payments, I'll take an example, don't worry. If payments are made in advance, first you will make the payment, then you will accrue the interest. So if payments are made in advance, in that case, next payment happens before the interest is accrued, before the interest is added. So current is full next year's payment, So in that case, no need to subtract the interest. Very logical also. Let's say, here there's a memory trick. If the payments are in arrear, subtract interest. If payments are in advance, take full. This is something that you can write and keep it somewhere, because this will help you a lot when you're solving question. This is one of the most tested areas. When it comes to leases, they will definitely test you on identify current and non-current portion of a lease liability. So for example, I've taken an example here. Lease payment is, let's say, 1 lakh per year for next 3 years. Discount rate is 10%. Let's assuming here PV is 2,48,685. Now initial entry is what? Let's say there are no prepayment, there are no indirect costs, so lease liability is equal to your ROU asset. So initial is ROU plus lease liability. Next year, what you will do? You will accrue interest on it. You will charge interest on your lease liability. So how do you charge interest? 248 into 10%. This will give you 24,869. What is the journal entry you will pass? Debit interest, credit lease liability. When you're paying, what is your payment? Debit lease liability, credit cash. Now, ma'am, if payments are made in arrears, so how do we identify it? Let's say here, opening. I'm just giving you a simple exam trick that will help you all understand it. Opening balance here, payments are in arrears. Payments in arrears. Opening, interest, payment, and closing. Okay. So I'll take that example. Let's say this example, 2,48,000. First year, my opening lease liability is 2,48,685. 2,48,685. I will charge interest on it. So what is my interest on it? Let's say it comes to 24,869. 24,869. And I'll pay 1 lakh, not 1 lakh. 1 lakh, of course, 1 lakh. I'll pay 1 lakh. So what is my closing liability? Can anyone help me with the closing liability? I'll just calculate the closing liability here. Just let me calculate it. So how do you calculate your closing liability? 2,48,685 plus interest 24,869 minus your payment of 1 lakh. So my closing liability comes to 1,73,554. Now let's say this becomes my opening liability next year. So next year my opening liability is what? 1,73,554. I will charge interest on it. Let's say interest on this is 10%. So this comes to 17,355. What is my interest lease payment? 1 lakh. So what is my closing liability in that case? 1,73,554 plus interest 1 lakh. Just let me do this. 1,73,554 plus interest of 17,355 minus lease payment of 1 lakh. So your closing liability in this case comes to 9909. So now how do we identify the current and non-current portion? See, when you're standing at the first year end, your total liability, first year end, your total liability is what? 1,73,554. Out of this 90,909 will go beyond 12 months, will be due even at the end of the second year also. So the balance is nothing but the balancing figure is nothing but your current liability. So this is your non-current liability. What is my balance figure? $82. 1,73,554 minus 90,909. So this gives me 82,645. So this is your current portion. So you all know in your balance sheet you will have to show your non-current your lease liability in two format, current and non-current. So this is the way you will classify. Ma'am, now just give us what if the payments are made in advance. I'll change this situation a little bit here. Payments in advance. So this, if you check it, if you analyze it correctly, this 82,645 is nothing but the difference of this two. 1 lakh minus the interest. 1 lakh minus interest. Current is next payment is 1 lakh minus the next year's interest. Now, if payments are made in advance, so what do you do here? If payments are made in advance, here your lease liability schedule will change a little bit here. Now, ma'am, how will it change? Can you help us? Opening, payment, interest, and closing. Let's say same, we'll keep everything same, keeping everything same. Let's say my opening liability is 2 lakh 48 685. What are my payments here? First, I will make the payment. So in the current year, of course, first year you will not make any payment. Payments are made in advance. You would have already made it. So let's say here interest will come of 24,000. What was it? 24,869. This will give you your closing liability. So 2,48,684. I'll not calculate it. I just want to explain you all how you calculate. This is very simple. So let's say there's some X amount. 2,60,000 something will be your this opening closing liability. Now next year you will have to make a payment of 1 lakh. So in that case, this will be your whatever is your okay. Let me just calculate it. This will help me. This will help you all understand better. So let's say what is my closing liability in the first case? What is my closing liability in the first case? Opening plus interest. What is my opening? 2,48,689 plus interest of 24,869. So my opening liability, closing liability in the second year is 2,73,558. Now what is first year end? My opening liability is 2,73,558. Out of this 1 lakh will be repaid in the next year itself. The next year itself 1 lakh will be repaid. So the balance, that is 1,73,558, is your non-current liability. So in this case, since the payments are made in the beginning in advance, whatever is your next principal repayment is your current liability and the balance is your non-current liability. So be very, very careful when you're analyzing it. If payments are made in advance, your next year principal repayment itself is your current liability. If payments are made in arrear, in that case, your today's current, current year's first year end liability minus the next year's liability will be your, the balance will be your current liability. Okay. Or if not that, you can just take the difference between the next year's principal repayment minus the next year's interest. In that case, that will be your current liability. I hope you are okay. I hope you are okay with this part. So this is an important area where you all can be tested on. Now, we're good with lease liabilities, initial recognition and subsequent measurement also. Next, we come to our ROU asset, right of use asset. You will have to depreciate it. Just one thing that you need to remember is you will have to depreciate it over a shorter of 2 periods, that is lease term or a useful life. Unless purchase option is reasonably certain, then the useful life. So usually they will not test you on this part. What you need to remember is whatever is a lease term, you will depreciate it over the lease term. Let's say 5 years, 10 years. This is the majority of the question. These are the generic questions. Let's say my ROU asset is of 2,48,685. What I'll do is I will depreciate 685. So whatever is a lease term, 5 years, I'll depreciate it. So subsequent measurement of your lease term will be depreciate. Depreciation entry is just like any IS 16 entry, nothing new. So please ensure you all are okay with these 2 entries. You will, if at all required, please show these entries. Okay, debit your interest expense will increase your lease liability and principal repayment will decrease your lease liability. Now we talk about lease term. Lease term includes, what is included in your lease term? Any non-cancelable period, any extension option and any termination option. So you will be have to check if there is any non-cancelable period, if there is any extension period, if there is any termination period. This is actually more relevant when it comes to here. You just have an introduction of what is a lease term. This is more relevant in your SBR syllabus. So just understand your lease term will include any non-cancelable period, any extension option if reasonably certain, and if termination if reasonably certain not to terminate. Okay. Now reassessment and modification, all of this is a part of your SBR syllabus. Everything is a part of your SBR syllabus. Now presentation in the financial statement. I'll come to this part. Presentation in financial statement. In balance sheet, ROU asset is your non-current asset. Always at a non-current. ROU, no current and non-current classification. Lease liabilities split in current and non-current. We just learned how to split. P&L, depreciation expense and interest expense. Now cash flow, principal is your financing activity. Interest is your operating or financing, and short-term lease payment are your operating. So pay attention. This goes to your even in P&L also, you know, as per IFRS 18, there is a classification. As per IFRS 18, there is a classification of operating, financing and investing. So this is your nothing but your operating. Depreciation expense, this is your financing. Lease and any payments related to lease and borrowings is your financing. So this will be shown under financing and this will be shown under operating category. Now lesser accounting is not a part of your syllabus, sale and lease back and all. Now we'll start with financial instruments. We'll start with our one of the easiest and one of the most interesting discussions of your chapter of your FR syllabus. Financial instruments, very easy and nothing to worry about. As far as FR is concerned, you all don't have financial instruments in a lot detail. Very simple, just financial asset and a financial liability classification. That's all. Now financial instruments. First, you need to understand, ma'am, what is a financial asset? What is a financial instrument? Sorry. A financial instrument is a contract. It's a contract that gives rise to financial asset for one entity and financial liability or equity for another entity. It should be a financial asset for one or financial and financial liability or equity for the another person. So in that case, we call it as a financial. Then that instrument is a financial instrument. And can you give us an example? For example, let's say we have 2 people here. Now, Surbi, that's me, and we have another person, Sam. We have Sammy. I sold goods to Sammy. I am a seller. I sold goods to Sammy on credit. So what is the journal entry that I will pass here? I sold goods to Sammy on credit. I'll debit receivable credit revenue. What is the journal entry? What is the journal entry that Sammy will pass? He will debit purchases and he will credit payables. So what for me, semi is a financial asset. For semi, I am a financial liability. So any instrument, any contract that gives rise to financial asset for one entity, financial asset for me, and financial liability for the another entity, then in that case we say that it is a financial instrument. Now, what you need to understand is, when I'm talking about financial liability, it can be either for Sammy, it can either be a financial liability or it can either be an equity also. So from finance, you need to, if it is a financial asset for one entity, it will only be a financial asset. It is not financial asset and equity or equity. Financial liability or equity, there's a huge possibility. Now, what are the examples of financial asset? Financial asset, trade receivables, trade payables, we have just understood. Loan given, loan taken, investment in bonds issued, cash, and bank overdraft. Now, what is applicable for you all? Here you will learn classification of your financial asset, measurement, and impairment. Of course, impairment, derecognition, and hedge is not a part of this, all a part of your SPR. All will be covered in SPR. For you, it's just measurement and classification. That's it. Now, classification of a financial asset. We'll learn first classification of a financial liability. Now, understand one thing, your financial asset can be classified in three ways. Your financial asset, first, let us understand what there are two types of financial asset. The two areas that are covered by the standards is, two financial assets that we will learn here is investment in debt instruments. And the next one is investment in equity instruments. Now, what is the meaning of investment in debt instruments? For example, I purchased bonds of Reliance Limited. So bonds are nothing but a debt instrument. So investment in debt instrument, I purchased shares of Reliance Limited. This is nothing but investment in equity instruments. So you will have to identify what asset it is. What financial asset are we talking about? If it is your investment in debt instrument, if it is your investment in debt instrument, then there are three possibilities. Your accounting can be done using amortized cost method, that is ACM. Second, you can classify your asset, financial asset, using at fair value through other comprehensive income or fair value through P&L. Now, ma'am, how do we decide which classification we should apply? Now, for this, you will have to do a business model test. What is the business model test? Now, what do you mean by business model test? Here, you will have to check why the asset is held, for what reason the asset is held. If asset is held to collect the contractual cash flow, then in that case, now, what is the meaning of contractual cash flow? This has been defined in the standard. Contractual cash flows are nothing but payment of principal solely, the principal and interest, principal plus interest. So, what is my business model test? Is my business model test to collect cash flow, hold and collect contractual cash flow. I just want to hold the asset and I just want to recover the contractual cash flow, that is a principal and the interest. So in that case, you will apply ACM. In that case, you will apply what method? ACM, amortized cost method. Now, what is ACM? We'll come to that part a little later. Just wait for a minute. We'll come to that part. ACM means when you classify your financial asset using ACM, when your business model is to hold the asset, hold the financial asset, hold your investment in debt instrument, plus collect cash flows, whatever are the cash flows, that is principal and interest, you want to collect it. Now, ma'am, when do we apply fair value through, when do we classify our asset using fair value through other comprehensive income? When you want to hold it, plus when you want to hold it and you may sell if it is beneficial to you. You may sell if it is beneficial. My dear friends, please be very careful when you're reading the question. If it is beneficial to me, if the prices are so high, the market price is so high and it is beneficial for me to sell the asset and recover, then I will classify that financial asset using which method? Fair value through other comprehensive income. And if any financial asset is held for trading, I've purchased the asset only for the purpose of trading. I'll just sell it whenever I feel right. So I don't want to hold the asset. So in that case, if your asset is held for trading, you will classify it using which method? Fair value through P&L, held for trading. Ma'am, are we talking about only financial, only instrument, investment in debt instrument? Yes, right now I'm talking about investment in debt instrument only. Now, one important thing that you need to be very, very careful about is, here, if you are classifying your financial asset through fair value, I'll talk about fair value through P&L and OCI first, then we'll go to the amortized cost method. If you are classifying your asset using fair value through other comprehensive income, investment in debt instrument, fair value through other comprehensive income. This you all know. In OCI, we have two items that can be declassifiable to P&L and items that cannot be declassifiable to P&L. So, investment in debt instrument classified at fair value through other comprehensive income. This is an item that is reclassifiable to P&L. So it means what, ma'am? What do you mean by reclassifiable to P&L? It means whenever you are selling the asset, when you're disposing the asset, any balance appearing in your OCI will be transferred to P&L. When you're disposing the asset, will be transferred to P&L. So this is an item that is reclassifiable to P&L. Any fair value gain and loss, if debt instrument measured at fair value through other comprehensive income, fair value gain and loss goes to OCI. Any on disposal, any balance appearing in your OCI will be reclassified to P&L. Now, what do you mean by fair value through P&L, ma'am? Here, if your business model is to hold the asset for trading, any fair value gain and loss will go to P&L, and of course here no point of reclassification. Okay, now investment in debt instrument, equity instrument. I'll just prepare a mind map for you all here. Later on, we'll learn this in detail. Here you have only two options. And what are the two options? Fair value through other comprehensive income and fair value through P&L. Then why not ACM method? Why do we not recognize our equity instrument using ACM, amortized cost method? Why is this not option available? See, amortized cost method is available only and only when your cash flows are nothing but principal and interest. In equity instrument, you don't have any principal, you don't have any interest. So in that case, there are only two options available to you all, that is fair value through other comprehensive income and fair value through P&L. Now, ma'am, what do you mean by fair value through other comprehensive income? Here, if any entity is choosing, if any entity has opted to measure equity instrument, investment in equity instrument at fair value through other comprehensive income, any fair value fluctuation on this asset will go to other comprehensive income. So, can I write here fair value? Here, you don't check the business model. Business model is to be tested only for your debt instrument. Here, just simple classification. So, fair value fluctuation, I'll write simple fluctuation goes to OCI. Any fair value fluctuation will go to OCI. If you have opted to measure your equity instrument at fair value through P&L, fair value fluctuation will go to P&L. So, ma'am, as you just said, as we just discussed in debt instrument, any debt instrument classified at fair value through other comprehensive income, it is an item that is reclassifiable to P&L. So, is this equity instrument is also reclassifiable to P&L? The answer is no. Any investment in equity instrument measured at or classified at fair value through other comprehensive income, this is an item that is not reclassifiable to P&L. Not reclassifiable to P&L. So it means, ma'am, where does the balance go? There will be any balance if there's any balance in other comprehensive income. So when we dispose or when we sell this equity instrument, where does this balance go? Any balance on disposal will be transferred to your retained earning. Any balance in your other comprehensive income on disposal will be transferred to your retained earnings. Are we okay? Now here, one more thing that you all need to be okay with, one more thing that you need to take care of is, this option is irrevocable. Now, what do you mean by irrevocable? Irrevocable means once you have opted to measure your investment in equity instrument at fair value through other comprehensive income, in future you cannot revoke it. In future you cannot change it. if you have opted, if you have chosen to measure your financial investment in equity instrument using fair value through other comprehensive income, it is an irrevocable option till the disposal of this asset. You will have to keep on measuring the asset at fair value through other comprehensive income only. So in general, by default, if you have any investment in equity instrument, by default it is to be measured at fair value through P&L. But if you wish to, an entity may choose the option of measuring the equity instrument at fair value through other comprehensive income. If you are choosing that, this option is irrevocable and you cannot reclassify, you cannot change the measurement in future years. Ma'am, is this applicable for debt instrument also? The answer is no. For debt instrument, reclassification is possible. If I've chosen to measure it at fair value through other comprehensive income, in future I can choose to measure at fair value through P&L. Yes, okay. The reclassification is possible in investment in debt instrument. Reclassification is not possible in investment in equity instrument. So these are the small areas that you will need to be okay, that you will need to be very perfect at, because these are the only areas where they can test you and where they can trap you. So these are some exam traps that you need to be aware of. Small things that as a student we get confused. So then what, in 2 lines, if I say investment in debt instrument, 3 possibilities: ACM, fair value through OCI, fair value through P&L. If it is OCI, it is an item that is reclassifiable to P&L and there is no such option of irrevocable. It is in future years also, it is reclassifiable. Now, if I am talking about fair value through investment in equity instrument, 2 options, only 2 options, no ACM. Why no ACM? Because no contractual cash flows, no principal and no interest. So only 2 options: fair value through other comprehensive income and fair value through P&L. If you're opting for fair value through OCI, by default it is fair value through P&L only. If you're opting for fair value through OCI, other comprehensive income, in that case, it is an irrevocable option. You cannot revoke in future years, and this item is not reclassifiable to P&L. So any balance on measurement, any balance appearing in your OCI will not go to P&L in future years. It will directly be transferred to this, what we say, retained earnings. Now, step number 2, here you will have to check SSPI test, SPPI test, solely payment of interest and principal. We have just had this discussion. So here, if your cash flows are not your SS, solely the payment of principal and interest, then it will go to fair value through P&L automatically. We know this already. That is why your equity instrument are classified at fair value through P&L and OCI. Why? Because there is no SPPI, that is solely payment of principal and interest. So, ma'am, what do you mean by amortized cost method? You measure it using effective interest method. Opening balance, add interest, less any payment, and your closing balance. Just like your lease schedule, you prepare an amortization schedule, financial asset amortization schedule, and here any gain and loss will go to P&L. FVOCI, fair value, OCI. Sorry, just not this. Here you will not, gain and loss will not be. If you are measuring at amortized cost method, there is no fair value through, there's no fair value measurement. If you are measuring fair value through other comprehensive income, OCI, this is reclassifiable. Fair value through P&L, fair value goes to P&L, and fair value through other comprehensive income, equity, if you have chosen to measure at equity, fair value, OCI, not recyclable. You cannot recycle it. Now, amortized cost method, what is the condition? You are holding to collect what? Contractual cash flow and solely payment of principal and interest. For example, your trade receivables, any loan given. So you will measure it using effective interest rate. FVOCI, hold to collect and may sell if it is beneficial. Changes, fair value changes goes to OCI. On disposal, recycle to P&L. We know this already. Fair value through P&L, it is a default category. If it is held for trading, if it fails to meet your SPPI classification, that is solely payment of principal and interest, and equity instrument, unless your fair value through other comprehensive income. Again, all the gain and losses will go to your P&L. Equity instrument, by default, I told you will apply fair value through P&L. Optional election at initial recognition. On day 1 of your recognition, there's an optional election that you can choose fair value through other comprehensive income, and no recycling on to P&L on disposal. So when you are selling it, no, you will not reclassify it to P&L. Now, financial liabilities. Also, you can write it here. this is your irrevocable option. Irrevocable means in future years you cannot reclassify it. Now financial liabilities, very simple. Only two methods here. What are the two methods? There is no OCI here. In financial liabilities, ACM or fair value through P&L. So most financial liabilities are measured at amortized cost method. Loan payable, trade payable, ACM. How do you measure ACM? Just like your lease liability measurement, ACM. You will have to prepare ACM schedule. And what is an exception? Only if it is held for trading or it is designated at a fair value through P&L. This is a part. This is not a part of your this FR. This will be tested in SBR. So you can ignore this for a while. So any financial liability measured at fair value through P&L is tested or is a more relevant in SBR syllabus. You don't have it in detail in FR. So what you need to remember is financial liabilities, only two methods. There is no fair value through other comprehensive income. It is measured at amortized cost method, generally amortized cost method only. There are only two exceptions, that is it is held for trading or designated at FVTPL. We'll come to that part whenever I teach you all SBR in professional level. That's the only way. Now impairment and all this is everything a part of your SBR syllabus. Now we'll talk about interpretation part. Interpretation will take up all the revision. Then we'll take a small 10 minutes break. Then we'll go to the revision parts, questions part. Then I'll pick up the questions. So that's a good thing, guys. In 2 hours we've covered almost in 2 hours we've covered 3 big chapters. You know, when you sit for studying on your own, you won't be able to cover 3 chapters at a stretch. At a stretch, you will not be able to cover. So you've revised all the important concepts of 3 big chapters and really important chapters from exam perspective. So the last part, interpretation of your financial statements. I'll share these notes with you all. Very, very important. This will, if you just read these notes, you will cover. I mean, if there's any question on interpretation, there's no way you will not be able to attempt any question on interpretation. I've tried to, simplify as simple as possible. After solving multiple questions, I came to a conclusion. Okay, how do you? Because usually students know how to calculate the ratios, but people get stuck when it comes to interpreting those ratios. So I've tried to, simplify as simple as possible. You just read these notes and try to solve any question. You will manage it properly. Now, what is interpretation, guys? It means analyzing the financial statements using the ratios. And explaining what do they mean. So now strictly from exam perspective, I've prepared these notes. What does examiner want? Your examiner will want analysis, comparison, explanation, not just ratio calculation. Ratios, I know you all can calculate, you all are very good at it. There's no way you will miss ratio calculation if you are okay with the formulas, if you've understood the ratios properly. But where you will get stuck is your analysis part. So I've tried to, in step by step, I've given you a solution. How do you solve your analysis part? So what are the areas we are covering here? What are the ratios that you will learn? Profitability ratios, liquidity ratio, efficiency ratio, gearing ratio, and some investor ratios. Now, when I'm talking about profitability ratio, the first ratio is GP margin. GP margin is nothing but gross profit ratio. GP, gross profit divided by revenue into 100. So what does this measure? It measures basic profitability before your any other expenses. So increase, if your GP is increasing? See, I've given you small hints here. What does this signify? If your GP is increasing, it indicates what? Higher selling prices or lower cost of sale. So how do you get GP? Revenue minus cost of sale is your GP. So an increase in GP is nothing but an increase in GP indicates higher selling prices. Either you have increased the selling prices or you have reduced any cost of sale. Decrease may mean decrease in GP means increase in competition or rising material cost. Either the competition has increased, there are more teachers teaching FR and SBR, so people are not coming to me, my revenue is getting reduced. So increase in competition and rising material. So in the case study, if they give you the competition has increased and you see that the GP is falling, so in that case, you can give the reason that this is probably the reason of increase or decrease in your GP. Now, operating profit margin. In operating profit margin, how do you calculate operating profit margin? Operating profit divided by revenue into 100. What does it measure? It measures profit after operating expenses. So if GP increases but operating profit goes down, for example, let's say in any year your GP is 25. Let's say I'll give you 2 years. 2025, 2026. In the previous year, I'll give you two ratios, GP and operating ratio. 25% and now it is 27%. Operating profit was, let's say, in the previous year, 20% and now it is 19%. So if your GP is increasing, but your operating profit is decreasing, it indicates what? Your operating expenses have increased. Your operating expenses have increased. In the previous year, your operating expenses were less. Now in the current year, your operating expenses have increased. So if you see such a situation, you can give what is the reason, because you will have to interpret it, right? So you will give the reason that because of increase in operating expenses, they'll give you some indicators. In the case study, they'll tell you, okay, current year the entity has incurred marketing cost, advertisement cost and all such. They will give you such expenses. So pick up those points, because these all points, every small point will help you solving the answer. Best part about interpretation question is everything is given in the question. The best part about any question on interpretation, everything will be given in the question. You will just have to pick the right points and mention the right points. They will tell you advertisement expenses have increased in the current year, like this and that. So this is nothing but an indicator that your operating profit may go down. So pick those points and put it correctly. Nobody will deduct your single marks. Now, return on capital employed. Now, ma'am, what is the meaning of return on capital employed? What is the formula for it? Operating profit divided by capital employed. Now, what does it measure here? It measures overall efficiency of the business. How efficient a business is. Higher ROCE, it means better performance. So if your ROCE is increasing, if your ROCE is more, in that case, you can say that the company is doing well. Now, the next one is, these were our profitability ratios. Now, we talk about liquidity ratios. What are our liquidity ratios? First ratio is current ratio. Current assets divided by current liabilities. Simple, very simple. Current ratio is nothing but current assets divided by current liabilities. What is the benchmark? It should be between, if your current ratio is between 1.5 to 2, it is good. If your current ratio is too high, means your current assets are more, and if too low, if your current ratio is too low, it means your current liabilities are more than your current asset. There is a liquidity risk. If your current ratio is too high, it means your current assets are more than your current liability. It means you're not efficiently using your funds. Now, what is a quick ratio? We often call it as acid test ratio. It is nothing but your quick assets divided by current liabilities. Quick asset divided by current liabilities. So what is the meaning of quick asset? Current asset minus inventory. Inventory is not considered to be a quick asset. So current asset minus inventory divided by current liabilities will give you your quick ratio. It measures immediate liquidity. Immediate liquidity means what? How much funds do I have? How much if I need funds immediately, how much liquidity do I have? Low ratio, it means you are inventory dependent. Now we talk about efficiency ratios. Now some ratios you will learn here: inventory days, payables days, and receivables days. So how do you calculate your inventory days? Inventory divided by cost of sale into 365. Mind you, this is denoted in number of days. 24 days, 100 days, 28 days. So this is always denoted in days. Do not write percentage and come. We have a tendency when we are calculating a ratio, we tend to write percentage. So don't write it in the form of percentage. You will lose marks. So it is always denoted in the form of days. Inventory 10 days, 20 days, 40 days, whatever. So if your inventory days are high, if after calculating this, you get high ratio. So it means what? You have a slow moving inventory. You're not able to sell your inventory properly, and you may have obsolete inventory. Your inventory is obsolete now. Low days means good inventory control. If your inventory days are low, means you're able to sell your inventory quickly. Now receivable days means receivable divided by revenue into 365. High days, it means what? Poor credit control. You're not able to recover your receivables on time. Possible bad debts. If you have really high inventory receivable days, it means there's a probability that your any debt may go bad. Payable days, nothing but your payables divided by cost of sale into 365. So high days means cash flow management, good cash flow management, and or it may indicate any supplier issues. So what kind of questions you can expect here is, let's say your payable days are high. You are paying your payables a little later. So they may tell you that because of this, it may cause any supplier relationship issue. Supplier is not okay with it. Supplier may want to, cancel the contract with you all. So please pay attention. If there are any such stories given to you in the question, please use it when you're calculating these ratios. Everything will be given. I'm telling you, everything will be given. Just pick the right points and put it in the right place. You will get marks. Now, gearing ratio. And what is the gearing ratio? First one is debt to equity. So what is debt to equity? Debt divided by total equity. High gearing, it means high financial risk, high interest burden. So if you are highly geared, it means you have more debt. It means you have high financial risk. Low gearing, safer but possibly under leveraged. Interest coverage ratio is nothing but your operating profit divided by finance cost. Low interest cover, less than 2 is risky. Less than 2 is risky. Now investor ratios, very simple. EPS, there's a chapter also, EPS, profit divided by number of shares. High EPS is good because investors want more EPS. P ratio is nothing but your market price divided by EPS. Price divided by EPS. High PE, high growth expectation, and or overvalued. Now, how to write? This is the main part. This you all should focus on. How to write your interpretation exams. How to write interpretation in exam. Step 1, if you're confused, if you don't know how to start, step 1, start by movement. For example, GP margin increased from 20%, 25% to 30%. Calculate the ratios and talk about the movement. Step 2, explain the possible reason why it may has happened. This may be due to better cost control or increase in selling prices. And how do we identify? This will be given in the question. They will tell you the selling prices have increased, the costs have gone down. So they will tell you. You just have to pick the right points. Step 3 is link to the other ratios. However, operating margin has declined, suggesting higher admin cost. So if you see your operating profit is your GP is increasing, but operating profit is decreasing, you link it to the other ratio and tell the reason for decline in operating profit is nothing but because of any higher admin expenses, any such operating cost. What are the golden rules? Never write ratios alone, please. Always movement plus reason plus impact. Simple. If you understand the ratio, if you understand what is the possible reason for the movement, you will get 100 on 100. You will get this right. Now, important analysis techniques. What are the techniques that we use? First one is trend analysis. You may be given in the question. They will give you in the question. You don't have to do any of this. You just have to see what are we analyzing. If you're comparing current year with the previous year, if they have given you one entity and they're asking you to compare the current year and the previous year, this is nothing but a trend analysis. Industry comparison. If they're asking you to compare with a competitor or with industry average, in this we call it as industry analysis. Industry comparison. Now link ratios together. How do you link your ratios together? Higher inventory days, higher receivable day. So in this case, you have a working capital problem. Now, as you know, as we covered yesterday, we had covered our cash flow also. So in cash flow also, they can ask you for the interpretation. There's one good question in BBB material on cash flow interpretation. But I'm telling you, cash flow interpretation is much more simpler than your financial statements interpretation. So this one small structure that we follow when you're calculating your cash flow interpretation, you start with operating profit, operating cash flow versus profit. You take your profit and you compare it with your operating cash flow. Operating cash flow is the, I'm telling you, this is the only where that you should be more emphasized. Operating cash flows are where you should be more concerned. Okay. Then you cover financing activities. Then you cover investing activities and the financing activity. So for example, your profit is high, but operating cash flow is low. So it means what? You are making a profit, but you're not managing your cash properly. So how to answer your interpretation of cash flows? Now you don't have group cash flows in your FR syllabus. You only have what? Single cash flow, single entity cash flow. So how do you want? What does the examiner want? It does not want number. You have to give analysis plus reason plus impact. Analysis plus reason plus impact. So step by step. Always start with operating cash flow. So in operating cash flow, there are 2-3 things that we cover. Any non-cash expenditure, any working capital movement. So ask if your operating cash flow is positive or is it higher or lower than profit. So first comparison is if your cash flow from operating activity, is it positive or negative? If it is positive, it is a good sign. It is a green flag in company. If it is negative, it is a red flag in the company. Then you compare it, is it higher or lower than the profit? So if your operating cash flow is higher than profit, it means good cash generation. You are making your cash flow is more than your profit, you're doing good. Strong working capital control, you have a control over your working capital. If it is less than your profit, it means poor cash collection, higher receivable and inventory, and possible liquidity issues. So you check this. If you have such indicators, you check, you compare it, you link it to your operating cash flow, to your profit. Always link to working capital. Always, if you're talking about operating cash flow, you will have to talk about working capital. Now we talk about investing activities. So investing activity, how do you identify? Check if company is buying asset, or is it selling asset, or investment for growth. High outflow, what are the possible reason? Expansion, future growth strategy. Selling the asset, cash pressure or restructuring. If you're selling the asset, it may be because you have some cash pressure, cash crunch, you're selling the asset and you're getting the cash. So it is not a good sign. Not a good sign. So this is a negative sign. You're selling the asset to get some cash, not a good sign. So you can mention it, because you cannot sustain in long term by selling the assets. Now financing activity. Have you taken any new loan? Any loans have been repaid? Any dividends have been paid? If our borrowings increasing, if your borrowings are increasing, then liquidity pressure, high gearing. You are paying high dividends despite your low cash, it means it is a risky policy. So in the question, they may give you that the company has paid a lot of dividend, but you're not making good cash. So in that case, it is a risky policy. Please mention that it is not good for company. Now we talk about interpretation of financial statement. So two possible questions. Either they'll ask you to interpret the financial statement, or they'll ask you to interpret the cash flow. So we talk about financial statement. How do you interpret the financial statement? Start with overall performance, big picture. Always begin with revenue and profit. This is the basic structure of your financial statement. Talk about revenue movement, how revenue has increased, profit movement, overall comment. So for example, revenue increased by 12% during the year, indicating the growth. So however, operating profit only increased, suggesting margin pressure. Give examiner, this gives examiner the confidence immediately. So this will give your examiner, okay, this person knows how to identify. Now then go for profitability. See, in one single question, they will not give you every possible aspect. They will ask you to calculate only 2-3 ratios. So see, what you need to check, ma'am, how do we know what analysis we have to give? In the question, check what ratios they are asking you to calculate. If they are asking you to calculate only profitability ratios, in that case, you will have to give analysis on profitability ratios only. If they are asking you to calculate more, maybe liquidity ratios, so in that case, you will have to give analysis on liquidity ratios only. So how do you analyze it? We know this. How do we analyze it? We know it very well. So profitability analysis, how do you analyze gross profit, ROCE and operating margin? State the movement, talk about the movement, increase and decrease, suggest what could be the possible reason, and link to the other ratio. We have just had this discussion. Gross profit margin declined because of this reason, higher cost and competitive pricing. This is consistent with the fall in operating margin. So always link the ratios together. Now when we are talking about efficiency, they will tell you about the working capital, maybe high inventory days, high receivable days, low payable days. So you will have to analyze inventory days, receivable days, payable days. So identify increase and decrease, explain the implication and link to the cash flow. So if they are asking you, one of the important suggestion is, if they are asking you to talk about efficiency ratio and they have also given you some cash flow information, please link it to the cash flow. Liquidity, for example, your inventory days, your payable days and your receivable days. Link it to your cash flow. If they have given you information about cash flow, please link it to the cash flow. Receivable days increased from 45 to 70, suggesting weaker credit control. This explained decline in operating cash flow. Now we talk about liquidity ratio, current ratio and quick ratio. We know current ratio has fallen from this to this, so indicating reduced short-term liquidity. Combined increase in receivable days suggest possible working capital pressure. Now gearing and risk ratio, debt equity ratio, interest coverage ratio. So here you will have to talk about what? Gearing has increased significantly, increasing what? Higher financial risk. Your debt is more than your equity. Interest coverage ratio has fallen, so suggesting reduced ability to serve the debt. Investor's perspective, if required, you will have to see whose perspective you have to solve this question from. Comment on EPS, dividend policy, share pricing. If EPS has increased, it may improve investor confidence. However, dividend payments have increased despite lower operating cash flow. This is not sustainable. You're just paying your investors dividend, but you're not generating cash flow. It is not a sustainable option. Cash flow interpretation has been already discussed. So how do you end your answer? You always conclude. You always conclude by overall. Just give the overall position. Shows a good revenue growth, declining margin, increasing in gearing, financial risk. Liquidity also appears to be weakening, short but commercial. So anything that, as per the question, this is just an example I've given to you all. So as per the question, whatever is your conclusion, you don't forget to conclude. Don't worry whether it is correct or not. Give a conclusion. Okay, this will give your examiner a confidence. So guys, we take a small 10 minutes of break. Then I've picked up some good questions for you all. We'll take questions in just next 10 minutes. So what time it is? It is 2:12. I'll see you all in just 2:22. 10 minutes. I'll be back in 10 minutes. Please take a break for 10 minutes. I'll be back. Are you all back? I hope you all are back from break. Let us discuss some questions. Then we'll wind up for the day. So we'll start with some questions from revenue. We'll start with some questions from revenue recognition. Okay. Now, C company, whatever is your pronunciation, you can take care of that. C company has entered into a contract on 1st of July 2001 to construct a factory for seed company. The total contract price is what? 2.8 million, which is expected to generate, just 1 minute, which is expected to generate a profit for C company. Seed company obtains control of the asset when it is as the asset is constructed. So seed company obtains the control as it is constructed. It is a sign. Which sign? I'm looking for you all. Hi, Krish. So here you will have to check whether it is a performance obligation satisfied over a period of time and at a point in time. So what here as I told you all, they will give you some indicators. You will have to identify. Seed company obtains a control of the asset as it is constructed. So C company has enforceable right to payment in respect of construction completed to date. Yes, okay. The contract states that performance obligation are measured according to certificates issued by surveyor. So which method of performance measurement we are using? Which method? See, this gives us an indicator that performance obligation is satisfied over time. I'll use this. Satisfied over time. Okay, now if it is satisfied over time, you will have to measure the performance. Now they are telling according to the certificates issued by surveyor. So can I say here we are using what? Output method. Output method. Now, C company measures satisfaction of the performance obligation under the contract by reference to the work certified as to, just 1 minute. Value of work certified as completed. At 31st of December, the contract was certified. The contract was certified by surveyor as 35% complete. So 35% of the revenue you can recognize. So 35% of the total contract price is your revenue. 80,000 has been invoiced to the customer but not yet paid. Now, very good question. Identify by selecting the correct option whether the contract asset or a liability will be recognized at 31st December 2005 and what carrying amount will be recorded in the statement of P&L. So my dear friends, what did we learn in this case? What did we learn? When your revenue is more, I'll take you all to that point. I'll link it to you all there when I'm talking about contract asset and a liability. This will help you all answer this question. So when your revenue is more than the billing, then you recognize what? Contract asset. When your billing is more than your revenue, then you recognize what? Contract liability. So here we know the billing amount. Here in this question, we know the billing amount. What is my billing amount? What is my billing amount here? 8 lakh. What is my revenue? What revenue will be recognized on the basis of percentage of work certified by the surveyor. So surveyor has certified 35% of the work. So can I say my revenue is 35% of the transaction price? That is 28 lakhs into 35%. My revenue is 9,80,000. How much have I billed my customer? 8 lakhs. So revenue is 9,80,000. Revenue recognized is 9,80,000. Billing is 8 lakh. So this is nothing but your revenue is more than your billing. Then this is your contract asset. With that small formula, with that small chart, none of your contract asset and contract liability questions will go wrong if you just follow that structure. I know in exam, one day before exam, we're confused. A lot of times we think here and there. Just structure, follow the structure. Right now, don't go into the logics and all. Of course, there are logics and we've covered that also. But what I want from you all is, right now focus on getting as many marks as possible. Focus on pocketing all this easy topics in your pocket so that you don't lose marks. See, a 2 marks question, every single mark is important. Isn't this simple? If you know how to identify your revenue, if you know how to identify, how to calculate your revenue, if you know how to identify contract asset and a contract liability, you will not lose a single mark, right? So just be very careful with this. So here in this case, we have a contract asset of what? 1,80,000. So here you have a contract asset of 1,80,000. Simple. Now second one is a company recognizes revenue. Now in the previous case we took output method, now we'll take input method. A company recognizes revenue on the basis of cost incurred. So cost incurred till date, it means what? Nothing but your input method of measuring your progress. Input method as a proportion of total expected cost. As a proportion of total expected. The client gains the use of asset during the construction. So client is controlling the asset as you're constructing. So it is a performance obligation satisfied over time. Following details apply to a contract where performance obligation is satisfied over time. Of course, when the performance obligation is satisfied over time, then and only then input and output method will come into picture. So what is my total contract revenue? 1,20,000. What are my costs to date? 48,000. Estimated cost of completion 48,000. Amount invoiced is 50,400. Amount received from customer is 40,000. What amount should be? They've already told you what amount should be recognized as a contract revenue. So see, first you will have to identify. To identify whether it is a contract asset or a liability, first identify what is my revenue to be recognized. What is my total contract price? 1,20,000. So 1,20,000 into percentage of work completed. So ma'am, how do we identify percentage of work completed? They have not given in the question. So here it is an input method. So tell me what are my total cost. Can I say my total cost is 48,000 plus 48,000? My total cost are 48,000 are plus cost incurred to date plus the estimated cost of completion. So can I say my total cost are nothing but 48,000 plus 48,000. This will give me nothing but 96,000. So what are my total cost incurred till date? 48,000. So can I say my 50% into 100? Can I say 50% of the job has been completed? 50% of the job has been completed. So you can recognize 50% of the revenue. So what is my 50% of this? 60,000 of the revenue can be recognized, and the amount that you have been invoiced. So your revenue is this amount that has been invoiced. The balance is nothing. But here your revenue is more than your invoice. Then you have a contract asset. You have a contract asset. So in the previous question, I've taken what? Input method. In the next question, I've taken, in the previous question, we discussed output method. Here we are discussing input method. Okay. Now here, the next question. On 25th of June 2009, Cambridge Company received an order from a new customer, Circus Company, for products for a sale value of 9 lakh. So my sale value is 9 lakh. Circus Company introduced a deposit of 90,000. Okay. 30th June, Cambridge Company has not completed credit checks on Circus Company and has not yet dispatched any goods. So can I say we've received money. We've received money of what? 90,000. But we have not yet satisfied our performance obligation. Yes or no? So if you have not satisfied your performance obligation, then what are they asking you? As per IFRS 15 revenue from contracts with customer, what amount should be recognized in each of the below transaction? So can I say I will not recognize any revenue? If there is no revenue, no receivable. So no receivable. Can I say I will have to recognize a contract liability of 90,000? Why 90,000, ma'am? Because you have received a deposit along with the order of 90,000. So no revenue, no receivable, just a current liability, contract liability of 90,000. Why 90,000? Because you've received it and you're yet to satisfy your performance obligation. Now, Repro Company, a company which sells photocopying equipment, has prepared a draft financial statement for the year ended 30th September 2004. It has included the following transactions in revenue at the amount stated below. What it has included, and these has been correctly included in revenue as per IFRS 15. Now, agency sale, what are they asking you? Sorry, let me read this question again. which of these has been correctly included in as per IFRS 15? So agency sale, they have recorded agency sale of 2,50,000 for which repro is entitled to commission. So this is not your, you will not recognize, you're an agent in this case, so you will not recognize this full 2,50,000, you will recognize only the commission. So this is not as per IFRS 15. Sale proceeds of 20,000 for a motor vehicle which is no longer required by repro. Again, this is not as per IFRS 15. This is not a sale as per IFRS 15. This is not your asset. Yes, I mean this is a sale. This is as per IAS 16, disposal of a non-current asset. Not this does not fall under the purview of your IFRS 15. Sale of 1,50,000 on 30th of September. The amount invoiced and received from customer was 1,80,000. 1,80,000 you have invoiced, which included 30,000 for ongoing services to be done by repro over next 2 years. So can I say out of 1,80,000, my total amount that has been invoiced is 1,80,000. Out of this, 30,000 is for some services that will be provided over next 2 years. For some services that will be for servicing work that will be provided over 2 years. So I cannot recognize revenue for this, but can I recognize revenue for the remaining 1,50,000? Yes, I can recognize. So what they have done, they have sold goods worth rupees 1,50,000 and they have recognized the revenue. So this is correct. This is correct as per IFRS 15. Now, sale of 2 lakh on 1st October. Sale of 2 lakh on 1st October to an established customer which with repro which has an agreement with the repro company will be paid on 30th of September 2005. 2 years later, we have sold goods for which we will be repaid when 2 years later. Repro has a cost of capital of 10%. So here you have a cost of capital. So you will not recognize this. You will not recognize this as your revenue. You will recognize your revenue at present value. So this is also not correct as per financing. So the correct answer is sale of 150. You have been invoiced 180 for which your ongoing services. So the correct answer is C. The amount recognized is 150 as performance obligation relating to service has not been satisfied. So 30,000 cannot be recognized. You will recognize this as a contract liability. Okay. Now, Gentle Company is a company which manufactures oven and supplies them to other retailers. There are no direct sale to public. So you are manufacturing something and you're supplying it to the other retailers. Which two of the following indicate Gentle Company should recognize revenue at a point in time of delivery, at a point in time? So when do we recognize? See, my dear friends, when you're solving such questions, identify when at a point in time is applicable. When the control has been transferred. If the control has been transferred, your revenue will be recognized at a point in time. If control has not been transferred, you cannot recognize revenue at a point in time. So the retailer must pay a penalty to Gentle Company for return in new oven which are in full working order. So can I say the retailer must pay a penalty to Gentle Company if it returns a new oven which are in full working order. So can I say I've transferred the ownership, Gentle Company has transferred the ownership to the retailers, because if they return the new oven which are in full working, they will have to pay the penalty. So the control has been, risks and reward have been transferred to the retailer. So yes, we say that in this case you will recognize at a point in time. The retailer has signed proof of delivery and unconditionally accepted the delivery. Yes, of course, this is a clear indicator of transfer of control. So you will recognize revenue at a point in time. Gentle has a statutory right to request return. Oven in exchange of original consideration without further compensating to the retailer. It is a sale with right to return. So here you will not recognize revenue. Here it is a part of your repurchase agreement. Here you cannot recognize revenue. Repurchase agreement, revenue can only be recognized in put option. When it is a put option, and in put option we will check significant economic incentive. Does the customer have significant economic incentive? If the customer does not have significant, if the customer has a significant economic incentive to put back, you will not recognize the revenue. If the customer does not have significant economic incentive to put back the asset, in that case, only in that case, we recognize revenue, and that too sale with right to return. Obsolete models of oven may be returned by retailer in exchange of original consideration without being further compensated. So any obsolete, here in this case, obsolete, any old. So in that case, we don't say that the control has been transferred. Your control will only be transferred when retailer sells it further to the other parties. So obsolete, any old models can be returned by the retailer. So we say that the control has not been transferred. So in this case, you cannot recognize revenue. So what are the two answers? The first two. When the control has been transferred, check whether the control has been transferred. If the control has been transferred, please recognize revenue at a point in time. If the control has not been transferred, no at a point in time. Now, the next one is, as per IFRS 15, revenue from contract with customer. Which of the following is an indicator that the performance obligation has been satisfied at a point in time? So, which of the following is an indicator? So, read all of this. Check. There are only 3 conditions for satisfied over time. If it is any of the condition of performance obligation satisfied over time, then you do not conclude it as at a point in time. Okay. So, entity's performance does not create an asset with an alternative use. An entity has an enforceable right to the payment, to demand to the payment for performance completed to date. The entity's performance does not create an asset with an alternative use to the entity. Can I say it is a specialized nature, asset of a specialized nature? And you have an enforceable right. You have a right. If you don't have enforceable right at a point in time, you have an enforceable right to demand the payment for work done till date. So it is satisfied over time. Approval of a contract creates enforceable rights and obligation given in the jurisdiction. You have approved the contract. So you now rights and obligations have been identified. Can I say at a point in time? The customer has a significant risk and reward of the ownership and the control. Yes, at a point in time. The entity's performance creates and enhances the asset that the customer controls. This is nothing but a condition of satisfied over time. The customer simultaneously receives and consumes the benefit, nothing but you're satisfied over time. So what are the 2 conditions? The approval and the customer has a significant risks and ownership. Okay. So we go to your IFRS 16 and IFRS 9 questions. Now, my dear friends, we'll discuss this question. I've taken some questions for IFRS 9 and IFRS 16. We'll start with this part. Just 1 minute, I'll drink some water. And 8%, 30 million. Now here, you'll please be okay. This question is about compound financial instruments, okay? And 8%, 30 million convertible loan notes were issued. Convertible loan notes were issued. Well, no, compound financial instruments, wherein it is a hybrid instrument. It has both features of your, what we say, it has a feature of both equity as well as financial liability. 1st April 2005. At par, the interest is payable in arrears at 31st March each year. Interest is payable in arrears at 31st March each year. So the loan note, what is the value? 30 million, 8%. Okay. And the loan note is, let me just change it, is redeemable at par on 31st March 2008. So can I say 3 years later, or convertible into equity shares at the option of a holder, at the option of a holder. Now, when any loan notes, when you have issued convertible instrument, please understand, when you have issued any convertible instrument, convertible financial instrument, and it is convertible, the conversion option is given to the holder, you account it as a hybrid instrument, compound financial instrument, because you don't know whether the holder will get it converted into shares or whether it will demand for the repayment. On the basis of 30 shares for $100 of a loan, a similar instrument without conversion option would pay an interest of 10% per annum. So here, my dear friends, you will have to find out the fair value of your financial liability. Now, fair value of here you will have to split. Firstly, understand it is your compound financial instrument, and you all know compound financial instrument, you will have to split between financial liability and equity. Now, how do we split financial liability and equity? You will have to identify the fair value of your financial liability using this rate, similar rate without the conversion option. So here they have given you the two rates. They have given you PV factor of your two rates at 8% and 10%. If they have given you the PV factor, please use that, because that will give you the more accurate answer. So see, my dear friends, here what is my future cash flows? What are my cash flows? I will have to make a principal repayment of 30 million at the end of the third year. Yes or no? I'll have to make a principal repayment of 30 million at the end of the third year, and every year I will have to pay 8% interest on 30 million. So can I say there are two cash outflows? What are my two cash outflows? Interest 30 million into 8%. Now every year I will have to pay interest, so you will multiply it with the cumulative factor. What is my cumulative factor here? For 3 years, using which rate? 10%, my dear friends. Don't by mistake, don't take this. 10%. What is the rate without conversion option? So 30% for first 3 years. This will be your interest, 30 million into 8% into cumulative factor of your 10%. That is the rate without the conversion option. So this will give you your present value. This will give you your present value of your interest component. Now repayment, at the end of the third year, I will have to repay 30 million. So what is the present value of 30 million? You will multiply it with the factor, PV factor at the end of the third year. So 0.75. So this will give you, cumulative interest plus principal will give you your fair value of your liability. How much did we receive? We received 30 million. So this is my liability, financial liability. This is my equity. So you will have to split. So consideration received will be split between financial liability and equity. So how do you split? Balancing factor is your equity. Find out your financial liability. How do you find out your financial liability? Take what are your future obligations, what are your future cash flows. You pull it using the present value. Using the rate, that is any rate that is given in the question. Rate without conversion option. So in this case, this is your present value of your interest payment, present value of your debt component, and total amount raised. So what have they asked us? What amount should be credited to equity? So what amount should be credited? This 1524. This amount should be credited to our equity. Why? Because it is our compound financial instrument. So a 5% loan note was issued on 1st April 2000. Its face value was 20 million. Direct cost of issue was 5 lakh. Just 1 minute. Allow me 1 minute. The loan note will be redeemed on 31st March 2003 at a substantial premium. The effective interest rate applicable is 10%. Now here this is a question of your financial liability. So you know financial liability is always measured at amortized cost method, ACCA. We only know that only under two situations. Anyways, that is a part of your SBI syllabus. They will not test you on financial liability at fair value through P&L. So only in two situations your fair value is your financial liability is measured at fair value through P&L. So when did we issue? Now it is a loan note was issued. If you purchase a loan note, it is a financial asset. When you issue a loan note, it is your financial, liability. So here it was issued on 1st April 2000. And what are they asking you? 31st March 2002. 1st April 2000, they're asking you what is the value of in the financial position at 31st March 2002. So ACM method, you apply ACM method. How do you apply ACM method? Effective interest rate, you will bring it to the present value. Sorry, you will not, you will recognize at a fair value. Every year you will increase it by the interest expense, and if there are any principal repayment, you will reduce your liability. So can I say initial measurement will be at cost minus, will be at, sorry, fair value minus any direct cost. What is my fair value in this case? 20 million is what I raised, and there was some direct issue cost. So initially I will recognize it at what? This 19,500. Now what is my interest expense? See, here you will take effective interest rate. What is my effective interest rate? Don't forget, do not charge interest using this. This is your cash flow. This is your interest expense. So what is my interest expense? Initial measurement is at face value, fair value, that is face value minus direct issue cost. Then you will charge interest on your face value, fair value, interest expense of this. Any interest paid 20 million. So every year you will repay an interest. So what will be your closing value at 31st March? 31st March 2001. This will be your closing balance. This will be your opening balance next year. Next year you will charge interest at the rate 10%. You will make the payment of this, and so your closing value next year, you can just simply prepare an amortization schedule here. I'll just show you how to prepare it here. Now they've asked you for 2 years here, opening. Now since ACM, in ACM, all your transaction cost will be reduced from your financial liability. So please don't forget to reduce it from your financial liability, ACM. Now opening, interest, cash flow, and closing. This is an extra closing. So what is my interest first year? What is my opening value? Opening is 20 minus 0.5. So 19,500. You will charge interest at the rate 10%. Don't forget EIR. Here you will take EIR, and when you are calculating cash flow, you will take rate of interest. So this 5% will be used while you are calculating. This 5% will be used while you are calculating your cash outflow, and this will be used, this effective interest rate. Just a simple exam structure I'm helping you all. So at the rate of 10%, you will charge interest 1950. You will write cash flow. How cash flow? 20 million into 5%. Into 5% will be your cash outflow. Every year you will have to pay an outflow, and this will give you your closing balance. Likewise, this will be your opening. You will charge interest and reduce your cash flow, and this will give you your closing balance. Okay. So 2 years later, this should be ideally, this should be the value of your closing value of your financial liability. 22495. 21495. Okay. So just, I hope you all are okay with this. I hope you all will be able to solve this. If these are very, very easy questions, if you get, please make sure that you all don't make a mistake here. Now on 1st January, K company invested in ordinary equity shares of B company. K company invested in ordinary equity shares of B company, paying 7.2 million. The shares at an additional 0.82 million broker's fees. Okay, no worries. The shareholding was less than 1% in B company's ordinary equity share capital. Okay, K company has made. So it is, why are they giving you guys? Why are they giving you this less than 1%? So if you all remember yesterday when we were discussing about consolidation and significant influence, I told you all, if it is 20 to 50% stake, then it becomes your associate significant influence. If it is more than 50%, you make it what? It is your subsidiary, you apply consolidation accounting. If it is less than 20%, it falls under the definition of IFRS 9. It will be your equity instrument, investment in equity instrument. So K company has made at, so what is my initial price? Can I say initial cost is 7.2 million plus what did I pay? An additional 0.8 million as my broker's fees. Okay, this was paid. Okay, now you have made an irrevocable election to classify this investment at fair value or other comprehensive income. I told you all, this is an irrevocable classification. You cannot change in future. at the recognition date. So can I say, if you are opting for fair value through other comprehensive income, any fair value gain and loss will go to other comprehensive income. At the date, at this date, what was your, at 31st December 2007, the fair value of your investment was 8.4 million. Okay. And this was correctly accounted for. Okay. 8.4 was my fair value. So can I say on 31st of December, when did I purchase it? 1st February 2007, I purchased it. What was the value? I purchased it at 7.2 plus the brokerage fees. Okay. Now on 31st of December, the fair value is, what is my fair value? 8.4. 31st December 2007, fair value is 8.4, and they have said it is correctly accounted for. They have not made any mistake here. So can I say they would have recorded correctly the fair value gain in OCI? Now we are standing at which date? 31st March 2008. K company sold entire investment for a cash consideration of 8.9 million. You sold this. So tell me on 31st of March, at what value this investment would be appearing in my balance sheet? Can I say 8.4 million? I have revalued it. I have revalued this asset on 31st of December. So can I say 31st of March, it will be appearing at what the carrying value will be? This 8.4 million. I sold this for 8.9 million. Now, what is a gain or loss on investment to be recognized in P&L and other comprehensive income for the year ended 31st March? So what is the gain that I will recognize in this case? What is my selling price? Sale proceeds, it was sale proceeds, very clearly evident. Sale proceeds is 8.9. What is my carrying value? 8.4. So balance 0.5 is your gain. So this will be recognized in other comprehensive income. So this is your gain. This is a gain that you will recognize. What is a gain to be recognized? What is the selling price minus your fair value? Minus your carrying value, sorry, not fair value. Now, identify whether each of the following does it indicate the contract contain lease or not. So a lessee obtains substantially all of the economic benefits. Yes, right. Lessee has, we know that if all of the economic benefits are with lessee, we say that it indicates a lease. Yes. Ownership of the asset is transferred at the end of the lease term. Yes, it indicates lease. The contract relates to an identified asset. Yes, if it is an identified asset, it is a lease. If it suits to do so, the lessor can substitute. So if lessor can substitute your asset, then we say that there is no identified asset. No identified asset, no lease. So does not contain a lease. Okay. So guys, I have taken up some more questions, but I think due to some time constraints, it's already 3. So I've tried to cover as much as possible. My main focus was on if anybody here, anybody attending this session is doing this for the first time. Even if you're studying it for the first time, my main focus was that you should get your concepts clear, even if you're doing it for the first time, even if you skipped while your regular classes, even if you were absent during your regular classes, if you skipped any of these chapters, you all should not feel should not be scared of any of these chapters. So of course, due to time constraints, I could not discuss as much in detail as possible as we have in class, but the main goal was that if even a single question is asked and if you get this right, I will consider this as a win, that with that one concept clarity you could manage to secure 2-3 marks, whatever. In professional exams, every single mark is important. So I wish you all the best. I'll have to wind up our session here. I wish you all the best for your exams. If you need these notes, just drop us a text. We'll share these notes to you all, and all the best for your preparation. Make sure all the important chapters. Now, just last 2 minutes I'll spend in giving you how do you plan your next few days. My suggestion, my advice to you all, as your friend, as your senior, as your somebody who has been through this phase, please focus on all what you know. Focus on all what you know. Please focus on your strengths. Any chapter that you're good at. I know in one subject we can have some chapters that are our favorite. We can still have some chapters that we don't really enjoy, that we don't really understand in one go. So focus on your strengths. Make sure, if For example, if you like consolidation, make sure you master consolidation so well that you do not lose a single mark on this. Do not pick any new chapter right now. If you don't understand leases, do not pick it up. Okay, whatever you know. Whatever what was supposed to be done till date has been done. Now don't take any new. Also, do not switch material. If you have been referring one particular author, please refer to that only. Do not change your notes. See, notes, why am I saying is, with experience, I'm telling you, with notes, we have a muscle memory. So a lot of times in exam, what happens? So you don't know how to calculate it. You may not be able to, the concept might not click, but the page number will click. When you're referring the notes, no? Because you've been using that note for a long time, you know that maybe at page number 45, this concept is given and at that page. So this gives you muscle memory. Right now, if you will change your notes, you will get confused. Your brain is so used to using those notes. Please stick to whatever you have been doing so far and give your 100%. Do not waste your single moment. Do not waste your single minute in any XYZ activity. No social media, no friends, no family right now. Your only goal should be your clearing your exam in one go. It requires a lot of money. It requires a lot of your time. So make sure you get this correct. You clear your exams in one go. All the very best to you all, and study with happy heart. A happy mind will give you more productive results. Will give you more better results. So stay happy. Study with a productive, happy heart and happy mind. And I wish you all the very best for your exams. Do well in your exams and take care, guys. Stay happy, stay healthy. See you all maybe some other day. Okay, bye, guys. We'll wind up for the day here. If you need any notes, just drop us a text. We'll share the notes with you. Take care, guys. Bye.